Hello, everyone. My name's Carlos. Thank you for joining our Robinhood Stock Market Watchlist Zoom meeting. It is Sunday, December 5th, 2021. And today we're just like always, we always go over the advanced, basics. And so, but first, just a little bit about myself. I'm the creator of the group. I have about 15 years of stock market experience, but mostly just long-term. But it wasn't until about 4 years ago I decided to get heavily into day trading. And so it was really a goal of mine to really master and understand everything about the stock market, what makes it tick, and all the benefits from it. Now, there's several different types of investors and traders, so we got to really understand how everything works and everything. That way you guys can kind of apply things to your advantage. And so the types of investors, you have your long-term investor, which is the most common, where you buy today and you hold until retirement or whatever, or many years. A lot of times those types of investors are looking for dividend paying stocks that are not only appreciating over time, but are also going to pay you a small percentage every like 3 months. And so that could be a huge benefit to those types of investors. But then you have your short-term investors that will buy today, maybe hold for several months or a year or so. And so then you have your swing traders that'll buy today and maybe they'll sell tomorrow or next week or a couple weeks. And then day traders are they're buying today and selling today, on the same day. Even though most people are pretty limited to that capability for accounts that are less than $25,000. But there's a lot of easy ways to get to that point, which we'll go over a lot of advanced strategies and everything. Then there's options. Options is a really neat thing that we'll talk more about today, where we can bet against the stock. If we buy a put, that is saying that we're betting against this stock, and if it goes down, your account goes up. But it also comes with a tremendous amount of leverage. Same thing with a call. If you bet it, a stock goes up. For example, Apple, for almost every 1% Apple moves is like a 50% gain or loss. And so, but we'll talk more about that later. So our training little webinar that we do normally lasts about 2 hours. The first hour, we go over all the advanced basics that we do week after week. And then after the first hour, we'll go over and kind of plan ahead for our week, kind of look to see what the week is going to look like, what's scheduled to happen. And then we'll go over some stocks and some plays and whatnot. But we always have to go over the basics, especially if we come out of a rough week or whatever, a rough time, or if you're just new. It's just always nice to have a little recap. However, the thing that all these types of investors and traders have in common is they all use something called moving averages. Our moving averages is part of our structure, our system that we need to use because it helps provide us our buying and selling signals. Without these, we'd be trading blindly. We'd be using what I call the hope system. You're throwing money at something and hoping that it sticks without really having any kind of structure or a strategy, and so you just need more tools under your belt, so that way you have more information on what to do, and that way you have a better buying and a selling intelligent decision. And so we're going to go over more information about moving averages, and then we'll move into patterns, because patterns is also another key thing that really helps provide us information on what the stock price is, what direction it's most likely going to go. Is it going to go up? Is it going to go down? But moving averages is key. We have to master our buying and selling signals, because it's just part of our system. So I'm going to pull up a video really quick. there's two of them. Each one's about 4 minutes long, and then we'll look into a stock market program. I use Webull, and that way we'll look at some live charts here really quick. So give me a moment while I pull that up for you.
The moving average is one of the most commonly used technical indicators. If you've spent even a little time looking at price charts, you will have noticed that most often the price of an instrument will move up and down. In fast-moving markets, you may find that the price may be surging up only to plummet moments later before surging up again, increasing the potential for false signals. The moving average can help filter out the noise from random price movements and smooth it out in order to see the average value. Moving averages are used to identify trends and confirm reversals. When the price is above the moving average line, we consider the instrument to be in an uptrend. Conversely, if the price is below the moving average line, we consider it to be in a downtrend. The breaking of the moving average line usually implies a trend reversal. Moving averages are also used to identify areas of support and resistance. Many traders will consider the moving average line as a support and resistance level indicator and base trades on it. So traders will check to see whether the price is going towards the moving average and see whether it will bounce back from it or break it, as with regular support and resistance level. Oftentimes, the price of an instrument will find support at the moving average line when the trend is up, and will find resistance at the moving average line when the trend is down. So moving averages will tell you whether an instrument is trending up, down, or if it's ranging. It can tell you if a trend is still in motion and whether it is reversing or losing momentum. Have in mind that a moving average is based on past prices and is known as a lagging indicator. Therefore, it will not warn you in advance, but it will confirm when a trend change has taken place. At the most basic level, when the price crosses up and over the moving average, traders take this as a signal to buy. When it crosses down under the moving average line, they consider it a signal to sell. Let's take a look at the types of moving averages. There are three main types: simple, weighted, and exponential. We will discuss the simple moving average, or SMA, first and show you how it's calculated so that you can adjust it according to the given market circumstance. So if you wanted to plot a 10-day simple moving average, you would add the closing prices of the last 10 days and divide by 10. This calculation gives equal weight to each day. It's called a moving average as the oldest price is dropped each time a new period becomes available. In this way, ensuring that the average is based only on the last X number of periods, in our example for the last 10 days. Have in mind that the longer the simple moving average period, the more it lags and the slower it is to react to the most recent price movement. And this brings us to its downside. As equal weight is given to all periods considered in the calculation, the simple moving average is slower to respond to rapid price changes that might prove to be important. So how can you counter this? With another type of moving average, either a weighted or an exponential moving average. The weighted and exponential moving averages are calculated differently from one another, but both types give more weight to recent periods and thus more emphasis on what traders are doing at the moment. So as a result, weighted and exponential moving averages respond faster to price action by distributing more weight to recent periods and less to older periods. They reflect a quicker shift in sentiment, which can be due to changes in supply and demand or important news events that impact the traded instrument. To illustrate what we mean, if you were to plot an exponential moving average and a simple moving average on a chart, you will see that the exponential moving average is closer to the current price than the simple moving average. Apart from the type of moving average, you also have to decide on the time period. This will largely depend on the type of trend you are analyzing. Here are some guidelines for commonly used time periods: 10 to 20 for short-term trends, 50 for mid-term, and 200 for long-term trends are typically used. When and how should you use moving averages? Deciding which moving average to use and the time period will depend largely on your objective. Use exponential moving averages for shorter time frames, or if you're analyzing a fast-moving market, as you'd have more emphasis on the latest prices. Use simple moving averages if you are planning on holding a position for a longer period of time, as the exponential moving average might be too sensitive and give false signals. You should also use simple moving averages if you'd just like to filter out the noise from random price fluctuations to determine the overall market direction. Thank you for watching this tutorial on moving averages.
Okay, I'm back. And so again, moving averages is extremely critical. And at the end, I will share this video with you guys because it is important that that you watch these videos regularly on a daily basis until you have every word memorized, until you have the whole thing mastered. But one of the key pictures I wanted to show you guys in this video is right here. Again, this is your buying and selling your buying and selling signals. It is like your assistant that's telling you when to buy and when to sell. It's like another language. We just have to understand the language so that way we can listen and understand what's going on. So as the price cuts down through the moving average line, that's your sell signals. So you have to imagine this little, system that's happening. So you have your sell signal, the price goes down. We don't know how long or how far, but eventually it's going to reach a bottom and the price is going to come up eventually. It's inevitable. It's just a matter of time that's going to come up through that moving average line. Once it does, it provides you your buying signal. That is your signal to buy, because it's letting you know that the trending direction is changing, and but it doesn't know how long or how far. And so in this case, this example, it actually went up over the last point there, and now as the price is coming down through the moving average line, it's providing you your sell signals. So this is really critical stuff that we must understand. And if you want to get used to doing one, you got to get used to the other one, no matter what the situation is. Even if you're breaking even and or maybe losing a little bit, whatever. And so, but it's just, but it also comes down to trying to configure your settings to your style in your trading and investing. And so that's where we're going to move into the Webull application. And Webull is another free, it's a great free application, just like Robinhood, and but it's more advanced. It's just got a lot more features, and it may seem overwhelming at first, but it is. It definitely provides a lot of great, great benefits. And you don't even have to sign into it to use it. You can download it from their website. You can download it from their if you want to download it and install it on your desktop or laptop. You can also download it on your mobile phone or tablet, and you can use it that way. But if you do sign up, it does open up a few more features. So, but it's a great tool to use alongside Robinhood app or any other application. So what we'll do is we'll kind of look at something here. Apple's a very common stock that a lot of people use, and so now I specialize in day trading and swing trading. So as the video was talking about different types of moving averages, like the MA for regular moving averages, or EMA, which is what I use, exponential moving average. And then you have maybe your simple moving average. Now each one reacts either a little slower or a little quicker to price movements. So if you're a long-term investor, you're going to want a slow reaction moving average. If you're a day trader or swing trader, you're going to want more of a reacting moving average. So EMA is your more reactive moving average. So, and that's what I have here. And so I use lines instead of candles. We can always right click on it, and we can click over line style. We can always change it to candles. I don't use candles because it does provide the similar volume information down below, so I don't need to duplicate it. It does appear to be a little more fuzzy. I like more of a clear picture of the moving average lines, because again, those are buying and selling decisions. We got to treat every dollar as if it's like a $1 million investment, because eventually that's what it's going to be. And so as long as you keep that mentality, whether you're investing $10, $100, $1,000, $10,000, each one's you got to treat it like $1 million, because eventually you're going to be trading some pretty high dollar stuff pretty soon, and eventually, like I said, you're going to be investing $10,000, $100,000, and your account's going to be in the $1 million. And so it's weird because the dollar amounts increase, but the percentages, keep the same, but it is a lot more adrenaline when you're dealing with large dollar amounts. And so it's just when you just need a lot clearer picture of what's going on, because every dollar counts. And so with Apple here, we can kind of see the Apple provided a sell signal over here. You can see that the price line cut through, and I use 3 moving average lines because it kind of provides me like a high risk, medium risk, and a low risk type of signal, meaning where if it touches the first signal going down, providing a sell signal, that's kind of like a high risk, meaning where it can still bounce off of that and it can keep going up. So basically there's a 25% chance it'll keep going down and a 75% chance it'll go up. The middle one is like a 50% chance it's going to go up, 50% chance it's going to go down. Once it touches that third line, there's a 75% chance it's just going to keep going down, and a 25% chance it's going to bounce up and go up. So in that case, it touched the third line, 75% chance it goes down, and it did, and it keeps trending down. And now over here, it provided a buy signal sometime last month in October 18th when Apple was around $144. And so we buy into that. We're listening to our assistant on that, and it's trending upwards. And so far, it has not provided a full-on sell signal, because the last signal is when the moving average lines crosses over each other. That's the last signal that we're going to get until it provides us the opposite signals. And so in this case, it kind of fumbled over here a little bit. It could be considered maybe a false signal. It just depends, but it looks like it was kind of fumbling there. But as long as you're focused on the crossover as the last signal, you would continue to hold otherwise, and then continue riding that wave until it does provide you your last and final sell signal. And right now, from the $144 buy signal, it's at 161, almost $162 now. So it did a pretty good job from there to there. And Apple being one of the most popular traded stock is because it's a very slow mover. It's very easily predictable, and so it's but especially with options, we can have some pretty huge gains doing it that way. So you can use moving averages with your normal daily stuff, but you can also do it with your day trading, And so Apple here, when it opened up, but it just depends on your style, and so you may have to go from 1 minute to 5 minutes just to kind of smooth out the graphs a little bit. But you can see that Apple provided a sell signal shortly after opening, and that's when you'd want to buy a put, bet against the stock, especially if it's on a bearish day. We can bad news can be great news. It just depends on how you use it. And so if we buy a put, betting against the stock, it just kept going down and down and down. Almost kind of fumbled up here. It could have came, but it just kept going down after that, and almost towards the end of the day. And so that's where we could have bought the put there, sold the put there, and secured our profits. Now the chart down below is the MACD. The MACD is basically 2 moving average lines without a price line, and one's slower, one's faster. But then we have these colored bars over here, these vertical bars. We have a red, and then there's green. These are gap bars, the gap distance bars between the 2 moving average lines. That way it kind of lets us know, is it below or is it above? And so, but it can still help provide us some buying signals or selling signals, sometimes even a little earlier than what the moving average graph does on the top. Now, how you would configure your moving average graph on your system is there's an area over here that'll display your type of moving average. So in my case here, I have EMA, And there's a little gearbox. That's our little setting button that we want to click on. Same thing with your mobile device. You just have to click on your moving average and then a little indicator, whatever there, and then the gearbox will appear, and then you just click on that, and then your settings will appear. And then on your main chart, you have all these for your primary moving average, and then you have your subcharts down below, which you can select up to 6, and that way you can select the your MACD. Now, between these two are probably one of the most commonly used indicators by successful investors and traders. And so a lot of these other ones are just kind of miscellaneous that some will kind of pick and choose. But the MACD and the moving average indicators are the top 2 most used by professional and successful traders and investors. So if they're doing it, you got it as well if you're not doing it already. So over here on the right are our lengths. These are by default. You can always change them if you want, but we got 5, 10, 20, 30, 60, 120. These represent trading days or trading time in a form. So if you're looking at a 1-minute graph, this would be your 5 minutes, 10 minutes, 20. Or if you're looking at it as a daily chart, this would be your 5-day, 10-day, 20-day. So the 5-day would represent a 1 week trading average price. This would be your 2 weeks, and then this would be our 4 weeks or 1 month, and then so on. And then so this is how you can kind of really configure it accordingly to your style in investing and trading. Now on the top here we have style. We'll click on that. And this is where you can select what types of moving averages that you want. So again, if you're more of a long-term investor, you'll probably want more like the maybe the 20, 30, 60 or the 30, 60, 120. And that will immediately change your graph. But if you're more maybe of a swing trader, you maybe want the 10, 20, 30. But day traders, will typically use your 5, 10, and 20. And you can change the colors to your preference in style. I know some people may be colorblind, so that way you can kind of adjust it accordingly to what colors that work best for you, or again for your for your preference and color theme and whatnot. So this is where you would go to configure that to your preference. And so let's tap into the second video really quick, and then I'll answer any questions that you guys may have here. Give me 1 moment.
We will now build on material. We will now build on material covered in the first tutorial on moving averages, where we defined what a moving average is, the 3 types of moving averages, and how they are calculated. In this second tutorial, we will discuss how to use moving averages to identify the direction of a trend, how they can be used to enter and exit a trade, and finally, how to trade moving average crossovers. To determine the direction of a trend using a moving average, you must take into account the set time period. We touched on this briefly in the last video, where we showed you the most commonly used time periods when analyzing short-term, mid-term and long-term trends. But why is it important to be aware of the time period of the moving average? In this chart, when we place a 20-period simple moving average by clicking the indicator icon and setting the time period to 20, we can clearly see that it indicates an uptrend. Yet when we place a 60-period simple moving average in the same way, we see that it shows the price in a range with no clear upward or downward trend. The difference in the direction of the trend portrayed by the moving average is due to the time period. Shorter period moving averages are faster at generating signals, and changes in the price of the instrument will be reflected more quickly. The longer period moving average will react to price changes much more slowly, but will generally provide more reliable trading signals. As a trader, moving averages will help you decide which way to trade by looking at whether the price is above or below the moving average line. In this chart, the price is above the moving average line and acts as support. You could buy and enter a long position when the price pulls back to the moving average line. You could then place your stop loss underneath the moving average. Here we can see the opposite. The price is below the moving average and acts as resistance. You could then enter a sell order when the price retraces to the moving average line and place your stop loss above the moving average. The interesting thing about moving averages is that they can be used alone or in combination with other moving averages. So when you place two moving averages on one chart with different periods reflecting a short-term and a longer-term trend in price, you have the opportunity to trade moving average crossovers. They can be used to determine when a trend has changed direction. Let's show you what we mean. On a daily chart for the pound US dollar, we will now place a 10-period simple moving average and a 20-period simple moving average. When a shorter period moving average crosses above a longer period moving average, it can signal that the trend is changing direction to the upside and it may be a good time to buy. When a shorter period moving average crosses below a longer period moving average, this is considered bearish, a signal that the trend may be changing towards the downside and it may be a good time to sell. No matter which two time periods you use, this principle will remain the same. To recap, a moving average is a lagging indicator that can help filter out the noise from random price movements to see the average value. It can help identify the trend direction, determine support and resistance levels, and can help confirm a trend reversal when looking at moving average crossovers. It is important to understand the differences between the types of moving averages and how to tailor the time period to best fit the trend being followed in order to gain the maximum benefit from this indicator. Thank you for watching this tutorial on moving averages.
All right. Anybody have any questions about moving averages? Everything makes sense? You can feel free to chat in the chat room, or you can unmute your microphone on the software in the Zoom meeting, or your microphone physically. But yeah, if you have any questions.
Hey Carlos, this is Joe. I'm wondering, like, with the entry and, you know, set your like when they say set your sale point, you know, below the indicator in the video, like, I don't understand that. So there's an entry and a sell point, but then there's a stop loss. Are they talking mainly about trading shares or trading options?
Either or. You know, but when it comes to puts, though, we kind of have to reverse the strategy, where a normal sell signal would be our buy signal for a put. And if you're into options, you can swap back and forth just depending on how volatile the day is. You can do both.
Okay.
But the moving averages is definitely when you have your you know, so like if you didn't sell and the stock was going down and you're holding shares, you would want to sell maybe when the next time it comes up, you know, and up on the line. Like, for example, we're looking at Apple right now, and if you forgot to sell on the sell signal and you're holding, you know, you would want to, because a lot of times what investors are going to do, they're going to sell when it reaches the bottom, and you know, and then it comes up a little bit and they're like, why didn't I hold for just a little bit longer, you know? Mm-hmm. And so the goal is to try to minimize your loss as much as possible, and to sell again when it touches your moving average. And so that's kind of like your support level at that point, even though it's trending downwards and hasn't provided a solid indication that it's changing its trending direction. And so that's where you would want to sell, minimizing your loss, if it's doing that. So any other questions?
Yeah, I have a question for the same graph right here. So from the graph, it appears that the optimum point to sell the one on the left hand corner, and because it's cross the moving average. But my question is, if I successfully able to sell it at this point, when I can rebuy it again, which other indicators I need to look at? You mentioned that if it's cross the moving average above, that means it's an indicator to buy, but maybe it's just a bounce and it's going to go back again, and it's happened many times for the selected period you are using. So this is actually makes for me many losses. And if you can explain like how to determine the true point to sell or to buy, it would be appreciated.
Yeah, and that again kind of comes down to what type of strategy that you're in. Now, most people are going to be most people are going to buy and hold for several days. Most people aren't doing day trading because they're limited to only 3 day trades per week or per 5 day trading period. And so in most cases, you're going to want to look at the daily graph. And it's going to be a lot easier. It's going to be smoother, less volatile than the 1 minute or the 5 minute chart. So, and by looking at this, and having my settings set so that's more reactive, you're going to have a lot more buying and selling signals. But it's still not that often because each little notch here is 1 day. So really, this could be like within a couple months or 30 days between your buying and selling signals. So that's not that bad. That's not that active either. So that's just a good, I think, a decent amount for somebody that might be pretty busy. But you can see that there's every time you see a crossover, that's a signal. So there's a crossover here, there's a crossover right here, there's a crossover right here. These are our signals. And so, but if you're more of a long-term investor, that's when you're going to want to change your indicator settings to something that's a little bit more mellower. So if we go to style, if I change it so that way we're on the 20, 30, 60, you'll now see that there's a lot less movement with the moving averages. There's less signals, and it may be more your style. And so that's where we really have to kind of, adjust, things accordingly. And it may take you, a couple days. It could take you a couple weeks or so just to kind of, figure that out. But this is your system. We have to learn more about this because this is the basics. This is where it starts. And just like any other profession, each thing, whether it's a hobby or whatever, we always have the basics. And when times are tough, and we're struggling with something, we always got to take a deep breath, relax, and just have an open mind and think back to the basics. And this is it, along with patterns that we'll jump into here in just a bit. So let me pull up the patterns for you, because moving averages help provide us the signals that we need, but the patterns will help provide us what direction that the stock is most likely going to go. So here is the what I call the cheat sheet for patterns. Now, patterns, most of the time we can find throughout the day, with our 1 minute, 5 minute charts, but occasionally we can find patterns within the daily charts. And but it's very important that we look at this daily, because out of sight, out of mind, and if we try to look at this every day and memorize it, we'll kind of imagine a square box around the price line, and we'll be able to identify that there may be a possible pattern there. And then you compare it with this and you'll be like, aha, this is a double top pattern. Maybe it's a head and shoulders pattern, which on the top left here, these are bearish patterns. So, and so a lot of times the stock market may open And for like the double top pattern, within 5 minutes after the stock market opens, maybe the stock price, comes up and kind of starts to hesitate there, and then begins to fall within the next 5 minutes. And it starts to hesitate, kind of forms this neckline, but then it bounces back up within the next 5 minutes and forms another high point, but at the second or at the same point as the first point. Starts to hesitate, and then the market starts to kind of maybe lose a little bit of momentum, and then it starts to begin to fall, starts to hesitate around that same neckline. Well, it's letting you know this is the double top pattern, and it with your moving averages, it's going to provide you kind of a sell signal. But in the options world, again, a sell signal is a buy signal to buy a put, bet against this thing. And so we'll see these three things here. We have an entry, we have a stop, and we have a target. Entry is kind of like, we need to enter, if this is definitely confirmed a bearish pattern, we need to enter buying a put, bet against this thing, and then as it begins to fall, the target areas is where we want to sell. That way we can secure our profits and repeat the process. However, we have a stop area or a stop loss, or if you did buy a put, bet against this thing. Or the stop could also be an invalid strategy, abort, because something may have manipulated the entire stock market system, or that particular stock, maybe somebody sent a tweet or something that and has changed the direction instantaneous. In that case, the strategy is invalid, and then to abort, and then to figure something else out. But most of the time that doesn't happen. Most of the time it always goes towards its intended direction. But just because it gets to its target area doesn't mean it's going to stay there. It can easily bounce back and form a bullish pattern. And so, but that's where we got to really watch our moving averages, waiting for that sell signal or the buy signal, because this really helps to provide more pieces of the puzzle. That way the picture becomes much more clear. That way we can make a more intelligent buying and selling decision. Now, there are quite a bit of bearish patterns here, but there's also a lot of bullish patterns. So like the double bottom, which is a good one to look at. A lot of times we'll also see that early in the morning where the stock market opens, then the stock begins to fall, and then we're like, what's going on here? And then but it's just the reverse of the double top, so it just bounces back, and you're not sure if it's going to come up. But as long as you're looking at this pattern here, this is usually like within the first 15 minutes, and then it begins to kind of come up past the neckline that it formed, and at that point it's going to keep going up for quite a while. But you just got to keep watching those signals, because that's really, really important that you don't begin to get thrown off track and go back to the hope system and being optimistic, because when you're optimistic, that's part of your emotions that's affecting your buying and selling decisions, and you want to keep the emotions out, because you need to think more strategically and statistically, analytically, using this system. It's very, very important. Another common pattern we'll see a lot is the bullish pennant pattern over here on the right, where the stock price comes up. And a lot of times we'll see this on a daily graph, as well as your 1 minute, 5 minute chart. I think, there was, I'm not sure what stocks, I can't remember which ones were already forming a bullish pennant, but a lot of times the stock price will come up, usually due to some kind of good news, or maybe something was revealed or scheduled to happen. The stock price comes up and kind of zigzags around this part. Sometimes that can kind of, frustrate a lot of investors, because, why is it going up even more? Well, be patient. It's about to, as it's getting close to the end of the little funnel here, which they call the pennant, that means it's about to react, and it's usually going to react very positive. And so that's where you want to enter right before maybe that little second or the third little spike there as it's going down, just to prevent, leaving money on the table. And then again, as it begins to shoot up, just wait until it provides that signal, that sell signal. Ride that wave. Don't sell early. And because you really want to maximize your as much gains as much as possible. Now there's these what's called bilateral patterns where it could be 50-50. So we got to really make sure that you're watching these particular angles, not getting confused with another type of pattern, especially like with the symmetrical triangle versus the bullish pennant. It can appear to be a little similar, but the symmetrical triangle, this price shoots up much faster than the bullish pennant, where the bullish pennant is more gradual. So if it does shoot up straight up, just like the symmetrical triangle here in the bottom right, starts to zigzag, at the end of the funnel, we need to wait until it provides a signal, whether it's going down or up. Once it reaches any of these parts here, that means it's going to keep going down or keep going that direction the rest of the way until further notice. And so with these, you got to be a little bit more careful. Let it wait until it picks a direction, and it'll tell you, and then ride the wave that direction. A lot of times we'll see the symmetrical triangle with with penny stocks. And so, or a lot of times you'll see that happen with earnings, you know, whether it's during pre-market or after hours, the stock price begins to shoot up. So it's really quick, begins to zigzag, and then it usually starts to kind of fall down and mellows out a little bit. So and I always post these in our group. I'll also post these later here in our chat room. Any questions on patterns or moving averages before we go on to the next part? Everything makes sense?
Yeah, if you can just give a little bit hint, what is the percentage I can decide for stop and target? So for entry, yeah, it seems it is, we can get this from the pattern, if it is a second bounce or third bounce, but for the percentage for stop loss, it is just a flying object. It's like a boundaries around entry. What is the percentage I should, like 5%, 10%, 2%, based on what I can decide, the target and stop?
So obviously the goal is to never have a stop loss, but in case if someone is in that predicament, we always want to have a good set of rules, which is what we're going to lead into next. But that is a very important part of a rule that every investor and trader must have, is what should my stop loss be? Now that just depends on your preference. A lot of people may have a stop loss if they're down 5%. Some might be 10%, but also in the options world is a lot more volatile. So it may be a little different than if it was regular shares. Because regular shares, like I said, stop loss would normally be about, if you're down 5%, 10%, it's time to get out, because or it depends on the situation. You may have to buy your average cost lower. It just depends on the stock and the situation. But at that point, you have to decide what to do. You can't just keep going down. You can't be one of those guys that you're down 40%, 50%, or 70%. And you're saying, what should I do? That just means you didn't have a system. You didn't have any of this stuff, or maybe you knew about it and you didn't abide by it. And so, but this is our Bible. We have to worship this stuff, because this is what's going to make us very successful and maintain our gains consistently. Because every part of the year, every season or quarter has a different type of characteristic with the stock market. As we're right now, we're in the fall season, almost towards the end. The fall is a transition from bullish characteristics to bearish characteristics. So we're starting to see more bearish characteristics because it's in that transition. We're almost in the transition of the winter season, which is really just a couple weeks away. So the winter time is where we'll experience the most bearish characteristics. Most days where they'll be red or down, whether it's significantly or slightly. Now the springtime is the transition from bearish characteristics to bullish characteristics. And then the summertime is just full-on bull mode, where almost every single day, every morning, every day is almost opened up green. and then the fall is or sometime in the middle where we start to see that transition. And it's a cycle, it's a continuous cycle, every time. And so if we don't have rules applied, or if we're not using a system, or if we're not using moving averages and patterns, we're going to be a mess. Because a lot of times people that are using the hope system, where they're throwing money at something hoping that it sticks, they usually do very well during the summertime. And then at this point, they're like, whatever I was doing is not working. I'm losing a lot of money. Help, what should I do? And so they're going to be a mess for the next several months, where we're not. We're going to use this. We're going to take advantage of it. We're going to make a lot of money. Again, bad news can be great news. It can be phenomenal news. It just depends on how we use it. This last week or so, it's been crazy for the stock market. It's been very volatile. Bring it on. We love that. We can make a lot of money. I made a ton of money a lot of gains last week from this, and I hope it continues. And but again, just depends on how we use this moment. And I'll show you some great strategies that we'll use to make a ton of money throughout the winter time. But we have to be able to master the basics. We have to set some rules. We have to have a stop loss. So if you're into options, again, our gains and losses are a lot more significant. So in that case, you may want to have a stop loss for options anywhere between 10%. If you're down 10%, 15%, or 20%. Any more than 20%, again, you're either going to have to try to buy your costs down, or you need to get out. You have to make a decision at that point, but it just really depends on the circumstance in the news. Maybe you made a mistake. It's time to get out. Don't put any more money into it. Don't lower your average cost. Or maybe you do, and you're just waiting for that little bounce, that little tiny bounce back up. Maybe you can recover a little bit more. But that's your exit strategy. Time to get out and re-strategize on something else. Any other questions before we move into rules? Any questions regarding moving averages or patterns? Okay, so let's get into rules. Everything should make sense. So let me open up rules here. Okay, so this is a list of rules that we're going to use as an example. These are just like a day trading rules, but they're very common. They're very basic rules. Now, rule number 1 says have some kind of limit on volume, no matter what it is. At least 1 million in average daily volume, or if it's stock options, have at least 1,000 in a particular, or maybe 5,000 or 10,000 in a particular. Call or put with a strike price, or maybe 100,000 in its overall option volume for that stock option. Whatever it is, have some kind of volume. Just don't trade, low stock volume, because they're not as volatile. You're not going to make a lot of money on that, unless maybe you really anticipate that something significant is going to happen sometime soon. But otherwise, have some kind of limit on that. Same thing with a price. Have a limit on a price. I definitely don't recommend anything or holding anything that's under $1, because if it's under $1, it's in violation of Wall Street's rules and regulations. And so part of the rules is that every company listed in the stock market has to be at least a $1 or more. Otherwise, they're at jeopardy of getting delisted. If they get delisted, the value of that stock is going to depreciate 50% a day until it vaporizes and gets delisted from that delisted system, and until the company goes bankrupt, and it's just a mess. And so avoid that, and just try to trade stocks at least $1 or more. And then percentage change, which kind of goes towards a certain time, whether with its 5 minutes, or if it's within the day or the week. Maybe the stock is up 10% a week, and maybe it's still going up. But again, that will provide you a lot of information with your moving averages. It would have provided you a buy signal probably at that moment, or quite a while ago. And so we really need to make sure that we're really seeing everything. And so the rule number 2 is day trade only. no swing trading. Again, that's just a preference, for everybody, but in this case, this is day trading rules. Now, but the reason why it's a rule on this is because a lot of day traders just like to day trade. They don't like the swing trade because they don't always know what the next day is going to be like. So if they can trade off of the current day, they can see whether if the day is bullish or bearish. So that they can kind of trade off of certain strategies. With that, they can get in, they can get out, they can secure their gains, and then they can repeat the process over and over the next day. But there are some great strategies for swing trading, which we'll get into here shortly. And then rule number 3 says trade stocks with news, press release, etc. It could be hype, whatever's creating a lot of activity. Those can be very volatile stocks that are making really big movements, which is phenomenal in the options world too. So that is great. Or even if you're penny stocks, penny stocks are usually stocks that are under $5. Usually you can find a lot of biopharmaceutical stocks that are very volatile. And so with good news on those, you can get some pretty strong movements. Rule number 4, try to trade stocks with maybe high volume of the day, or stocks with also a very high market cap, like Apple, Tesla, AMD, Nvidia, all kinds of different ones, Microsoft, Facebook, and so on, because they just move very slow. They don't move very much. They're very predictable. And so we can make a lot of money in the options world. So rule number 5 says enter at midpoint of support and resistance. Again, that is the moving averages. As the price that's under the moving average begins to come up, that's kind of like your support and resistance level. So we need to look at those and be very vigilant of your when you're receiving a buying and selling signal. Now, rule number 6, it says to always use your limit buy and a limit sell. Now, if you're doing options, it always defaults to that. But if you're buying shares, it usually will default to a market buy and a market sell. Now, the difference between the two is when you do a market buy, you're telling the system to buy and at any price at that moment, even if it's at a higher price than you anticipated. If you do a market sell, you're telling the system to sell right then and there at any price, even if it's at a lower price than you anticipated. Now, if you do a limit buy, you're telling the system to buy at your price or less, whichever is in your favor. If you do a limit sell, you're telling the system to sell at your particular price or higher, whichever is in your favor. Now, the disadvantage to doing a limit buy and a limit sell is that it might not execute immediately, because as you're typing in your price and your settings and stuff and getting ready to send it out, the stock price may have already passed that. And so by the time your order gets sent out, it might not execute until the price touches that. So you may have to go back in there, replace it, modify it, or you may have to just cancel it altogether and start over. And if that happens, a lot of times the price could keep going, and now you're trying to chase the price. So the best way to try to avoid having to chase the price is to, when you're doing a limit buy, try to put your price maybe a couple pennies higher than what you would what you would have. Or if you're doing a limit sell, put a sell price maybe that's a couple pennies lower than what you would have. So that way, by the time you send out the order, that you kind of made the difference for the time it took you to send the price or your order out, because it could, like, again, it could have taken you 5 seconds, could have taken you 10 seconds, 15, 20 seconds to do all that. Each program is a little different. That's one of the things that I like about using the Robinhood app, is it doesn't ask you a lot of questions. It doesn't ask you a lot of things. It's very, very quick, very simple. Just bam, bam, swipe, and there it is. And where most other programs, it's a lot more sophisticated, will take a little bit more time. And so when it comes to speed, I think the Robinhood app definitely has it there. And so rule number 7, it says ABCD pattern, enter at the C point. So I'm going to pull up a new image explaining what the heck that means and what it is. And so here it is here. So here's the ABCD pattern. So So normally this is usually a daily thing. So the stock market opens, and usually within the first 15 minutes, the stock price breaks out and sets an intraday high. So this is the A point. So this is usually about 15 minutes after opening. We're right here. Then the next 15 minutes, then the stock price pulls back and sets an intraday low point. So that's right here. So that's our little low point here of whatever that it is. And so it's usually about 30 minutes, between here and here. And so usually within the next 30 minutes, the stock price sets a higher low and begins to turn. So, but it also at the same time is kind of providing a pattern, maybe like a bullish pennant pattern of some kind. But usually between open and right here is 1 hour. So it's saying just wait after 1 hour, wait for the volatility to mellow out, and to identify what the stock price is going to do for the rest of the day. Is it going to go up for the rest of the day, or is it going to go down the rest of the day? At that point, it's going to provide a sell signal or a buy signal. And in this case, as it picks the direction, your moving average provides you your buying signal as the price line cuts through all the three moving average lines, and then it begins to go up the rest of the day until further notice. And so that is the whole idea, is trying to minimize your now you can trade throughout the first hour, but it's a higher risk. But if you're trying to lower the risk of your day trading, it's just saying just wait the 1 hour, be patient. And a lot of things can happen within the first hour. You have a lot of buying activity, you got a lot of selling activity, but a lot of times we'll get a lot of government economic reports that'll also create a lot of volatility. And so a lot of investors will wait for the results of the economic reports to see if they're positive or negative. Are they going to create a bullish reaction of characteristics, or are they going to provide a bullish reaction of characteristics for the stock market system? And so in this case, whatever the economic report was, it was probably good, and then the rest of the day it's going to keep trending upwards. So that's the ABCD pattern. Enter at the C point is just saying just wait for 1 hour. If you're trying to lower your risk as much as possible, rule number 7, ABCD pattern, enter at the C point. Now the rule number 8 says sell 50% of your position at a target goal. Now that's not really a day trading rule. Day trader gets in and they get all the way out, and they repeat the process again. They don't leave anything behind. However, I do see a lot of long-term investors that will do that. They'll invest a certain dollar amount into some stocks, and then the stock goes up. And then at a certain point, they'll sell what they originally put into it. So whatever's left over, they feel it's free money. It's just sitting there, no matter what it is, and then they'll repeat that process on something else. And then rule number 9, it says beware of the false breakouts. Sell right below the support level. Now we've talked about the false breakouts, which are due to your moving averages, and that's where they have to be set accordingly to your style of trading and investing, because you don't want too many selling and buying signals if you're not going to be that active. If you're not going to be that active, you need to configure your moving averages so that way it provides you the least amount of buying and selling signals, because you may get a signal that could be false with your type of style. And so rule number 4, it says cut losses if you're down 2 or down 5%. Again, we've talked about stop losses. Always have something, whether it's that 5%, 10%, or in options 10%, maybe 20%. And then ride winners at least 10% or more until further notice, until it provides you when to sell. So these rules are just kind of the basics, the most important top 10, but there is definitely more that you can always add to your personal set of rules that you must never break. And so something you can write them down, you can print them out, post them somewhere so that way you can always see them. Just don't ever break them, because it's always about maintaining our gains and consistency. And so there is another pattern I wanted to pull up before we move on to the next thing. This pattern, which is very, very common too, is what's called the dead bouncing cat pattern. And we see this on a daily basis for many stocks. And so where the price reacts to some kind of news, it could be bad earnings. It could be maybe a biopharmaceutical stock. Maybe it's a drug company that has been working on something for several years, maybe some kind of cancer treatment. And all of a sudden, the government, the FDA doesn't approve because maybe they only had a 68% success rate. It just wasn't really up to the standards that we need. And then there was, but in the last year, there was a lot of optimism, but not anymore. That price, whatever happened, the price quickly drops. But because it drops significantly, a lot of times investors think of that as a good opportunity, and it can. And if you buy there, it can bounce off, and you can definitely have some good amount of gains at that point. But then the price can easily begin to fall. And with your moving averages, it's going to provide you a sell signal. So at that point, and this could be within 5 minutes, 5, 10, 15 minutes, it's usually very, very quickly. But if it does provide you a sell signal and you're in this situation, you need to sell. You need to sell right away, because a lot of times what happens, this price will then fall right here, right at that second point right here. We just got to wait to see what it's going to do, because maybe it's the double bottom pattern. And so, but we got to wait to see what it's going to do, because if it's going to bounce back up, then it is the double bottom pattern. But if it begins to fall past this point here, it's going to fall the rest of the day. And if it does, you might as well take advantage of it, bet against this thing, buy a put, and then profit from it. And then wait until it provides you your sell signal, which would normally be a buy signal in a way. But when it comes to puts, we got to reverse the strategy. And so, but this is very common pattern that happens again on a daily basis to many different stocks. And so, just like what was that the other day? DocuSign. When you look at the beginning of the day with DocuSign, which is very interesting situation with that stock, as they had beaten their revenue and their earnings, but they still had plunged over 40%, which is absolutely nuts. But in the beginning of the day, it definitely did this a pattern. But like I said, it happens regularly. Normally, it's with like penny stocks and whatnot. But it's very good to know, just in case. That way, you can take advantage of the situation, because the more you learn, the more you're going to earn. So let's go on to the next thing that is also very, very critical to know. And that is knowing the difference between an amateur trader and a professional trader, because you don't want to be an amateur trader. If you're an amateur trader now, it's time to become a professional trader. But the only way you're going to know the difference is if you're taught. Just like if growing up as a child, our parents taught us the difference between right and wrong. Well, this is the difference between right and wrong, between the amateur trader and the professional trader. The amateur trader will let losers run and hope they turn around. Well, there's that word hope again. They're using the hope system. They're throwing money at something, hoping that it sticks, because they're not using a system that's communicating with them of when to buy and when to sell. Where a professional trader will cut losers when a stop is reached and a trade idea is invalid, which we've talked a lot about in the last hour. We've seen what a stop loss, what a stop looks like, or we've talked about our stop losses and when a trade idea becomes invalid. An amateur trader will then close winners too early because of fear of giving back profits. Again, they're not using a system, using moving averages and patterns, because they threw money at something, they got lucky, and they wrote it up a bit. Maybe it was hesitating because maybe it was providing a bullish pennant pattern. It was letting them know, hey, I'm ready to go surge back up again. And because it was hesitating on this little funnel pattern, they got scared and sold. And then as soon as they do, boom, it goes right back up again. They're like, why did I do that? Why did I sell? You could have a trailing stop loss too, where, if you're up, 20% and maybe you can do a stop loss, maybe if you're up at 15% or a dollar amount. So if it does go down, you can stop there, secure your gains, whatever. You just have some kind of system in place, and just don't use the hope system. Where professional traders will let winners run until a profit order or when a clear signs are given to exit. Trust their system. The system is moving averages and patterns. You must trust it once you have it completely figured out and mastered. Amateur traders change their trading system after a few losing trades because they're using the hope system. And a lot of times you'll see those will go on social media. Hey, I got $1,000. What should I invest it into? Because they're just hoping for something, and just they're just trying to change something because they just don't always know what works. Because again, as we were in the summertime, and now we're in the fall, whatever they're doing now isn't working anymore because things are getting ready to go down. So now we have to adapt and use different strategies to continue gaining profits. And so with these guys, they're going to end up quitting is what they're going to do. And we don't want to do that. This is our career. This is my career. This has got to be your career. We can make a lot of money doing this from home in a matter of just a few hours a day. And so, you can make $1,000 a day. You can make $10,000 a day. You can make $100,000 a month doing this from home. And if you keep participating in these meetings and following the structure and participating in our chat rooms, and you guys are going to make a lot of money. And have been. I know some of you guys are new, have just been here, in the last couple of days. Some of you guys have been here in the last several weeks. And the ones that have been here in the last several weeks have been making a killing amount of gains. And so, and you are too, just keep following. And so, professional traders will stick to their rules religiously and think process oriented. So, and we talked about rules because every investor and trader must have some kind of rules, because if you don't have rules, you're just going to be a mess. And so we got to think process oriented. We got to think statistically, analytically, but also strategically. And that's really, really critical, because the stock market is like a battlefield. It's war. And so strategically we got to know, we got to know what's going on, even though if we're being lied to by a politician or a CEO or whatever, we got to be very aware of what's going on. But we also got to stick to the process. So an amateur trader will often close their trades, never look at them, and avoid a learning effect, because they're just always throwing money at something, hoping that it sticks, and never learning. And that's why they're always just on social media asking, what should I do? Professional traders will analyze their past performance, keep a trading journal, and learn from their past behaviors, but also learning from other people and learning from their mistakes. That way they don't make the same mistakes. So always learn. The more you learn, the more you're going to earn. Amateur traders will sometimes overtrade and often revenge trade and hope to make a lot of money fast. Now, there's nothing wrong with making a lot of money fast as long as we do it the right way. But also the revenge trade part comes from the emotions. We got to keep the emotions out, because if you get emotional, bad things can easily happen. And that's why they say never buy anything based on emotion, especially if you're doing car shopping. Same thing with stocks. Never, buy or sell anything on emotion. We just got to think statistically, analytically, and strategically. But professional traders are aware of their emotional impacts and know how to identify and manage their impulsive buying and selling decisions. So it's very, very important. An amateur trader will open their trading platform and then desperately try to find random trade entries. The professional trader will keep a trading plan and plan their trading day ahead, follow a structured approach. Now, a professional trader doesn't need, at that point, a professional trader doesn't need anybody or anyone to help them really, but it's still great to have a team of veteran investors and traders in our chat room, because we are basically a team of stock market ninjas, where we can really, we specialize in different things throughout the stock market, so that way we can really become a very highly effective team. And so that's why we are very very well group here. And so But one of the things to create a trading plan is to kind of do this, and that's why we do this every Sunday, is to try to look ahead and see what's going to happen. That way we can determine whether each day is going to be bullish or is it going to be bearish. But one of the things that's very important to know is what affects the stock market. And one of the key things is economic reports. Economic reports has a huge effect on the entire stock market system, not just like a little segment of it, like sometimes earning reports can, where if a company beats their earnings or misses their earnings, it can affect, maybe the technology segment or the energy segment. An economic report can affect the entire thing. So if you now know that, it's only in your favor to master economic reports. And so when it's scheduled, we know, a certain day and a time of when that's going to take place. So that just means volatility. And again, I've posted a lot of these alerts in our chat room in the last several weeks, and a lot of you have probably noticed that and noticed how effective that is and how well that it helps us determine whether the stocks are going to continue going up for the day or if they're going to go down the rest of the day. I mean, it really is very, very effective, and it works like clockwork. And the more that you use it, the more that it helps. So let's dive into that really quick, unless anybody has any questions about anything that we've talked about so far. Okay, everything makes sense. That's good. Okay, so let's switch over to, okay, so we're talking about economic reports. So I use a website and an application called investing.com. It is a phenomenal, great source of information. They give you a lot of great news information, probably one of the best ones than anybody else. But they also provide live U.S. futures by the second, rather than updating once every 15 minutes or so. But then we have the economic report that's right here. So once we click on that on their website, now if you downloaded it from the your app store, it'll look like it'll be a calendar icon on the middle bottom of your screen. And on the calendar, you'll be able to change it between, your earnings calendar, holiday calendar, or economic calendar. You'll need to change it to economic calendar. Now, we'll need to clear some things here. We need to go to filters. We need to clear everything. So just click on clear. That's right there. There's only two things that we need to select and to see. We need to put a check mark under the United States. And then over here under importance, we have 1 star, 2 stars, and 3 stars. We want to put a check mark under 3 stars because we want to see everything that's going to provide the biggest impact on the United States stock market system. So we click apply. We'll scroll up here, and then we want to click this week. Now, as we had mentioned last week about this week, that this week looks very, very short. Unlike last week was very, very busy. There's a lot of things that were scheduled to happen. But I do see a few more things that have been added here since last weekend. But Monday, there's nothing scheduled for economic reports on Monday. So Monday is basically going to be a very interesting day because there's a lot of things that could happen. The Monday could easily surge or it's going to plunge. So if Monday tomorrow morning surges, is because it's bouncing back from last Friday's plunge. And that's very typical that happens. I've seen this happen many times year after year when we have a very, very red day that makes national news. But it will. I mean, there's a lot of people that bought a lot of calls last Friday. So there's a lot of people that are very bullish for Monday. But Monday, we're going to get a lot of news about how there's more cases of this new variant COVID virus in other states. And so that's going to create some bearish, a little bit of bearish activity, but also the big thing though is this whole China thing and whatnot. I don't know if you guys are aware. I think it was last Thursday, our government, the United States, threatened China again. They threatened China, saying that we could possibly delist Chinese stocks from the U.S. stock market, and that always pisses off China tremendously, and they always retaliate in some form, and but the reason why our U.S. government is saying that we could possibly delist Chinese stocks from the U.S. stock market is because we need China to implement some of our regulations with their companies, meaning where we need to be able to audit their earnings and their revenue, because when a company says that they have beaten their earnings, it's been proven. All the their records are on file with proving that what they're saying is accurate, and the whole world is on board with it. India, Europe, it's all regulated, but for some reason, China's like, they don't want anybody outsiders tampering or looking at their accounts or their numbers and whatnot. And so when any Chinese company says they beat their earnings and they reveal their revenue, it's just words. We don't know if it's actually legit or not, because it's not actually proven. It's just words, and so that's why, and so the U.S. government's now saying that it's time to change it. You guys, we need to have this audited, so that way, that way it's fair between everybody else. Why is everybody else audited and you're not? And so they've gotten away with this for far too long, and so. And that's why we're seeing a lot of Chinese stocks that are plunging like crazy. A lot of people are selling because they're scared. They don't know if they're going to get delisted. And we had the whole DD stock that was one of the first ones to get delisted, and so it's just a warning that the government is sending to China. Now, China retaliated by selling a massive amount of cryptocurrency. So a lot of cryptocurrency has been plunged like 20%. And then China will buy back in, and then it kind of pumps it up a little bit. They'll sell right back. So China's making a lot of volatility in the cryptocurrency world, but they're sending a message too. You keep screwing with us, we're going to screw with the world and screw with you guys. And so it's just creating a lot of chaos, and that is, I think, overall is going to affect the stock market more than anything else, more than economic reports, more than anything. And so, all eyes on this situation with China, the cryptocurrency, our stock market. This is going to be a big nightmare. But however, as we're going into the winter season, as we talked about, that is the bearish time of the year. It's just, these types of activities are meant to happen anyways. But what's going on is we're basically pouring fuel on the fire. The fire is just a tiny little thing, but they're making the situation more volatile, because that is more opportunities. We just got to play it right, especially with Chinese stocks. Stay away from Chinese stocks. They're going to get delisted, but it's still going to affect other stocks that are not at jeopardy of getting delisted. And that's where we got to really take advantage of everything. So now going into Monday is going to be a huge mess. So to be determined, we'll have to see what the U.S. futures are going to look like. That starts here in about here in several hours. So, but by looking ahead into Tuesday, we have the EIA short-term energy outlook. So when we're looking at these on the website, the times are going to be based on East Coast, on where New York is at, and so you have to be aware of your timing and stuff. But if you're looking at this on your phone or your tablet, it's going to be based on your time zone. So it's really, really critical that you're aware of your time differences and everything. That way, because when these reports are released, they're released instantly, and so at the same time that the news companies are collecting them, you're collecting them, you're receiving this information at the same time. Now the news companies have to take time to digest the information, to create an article, and then start blasting it out. And so they could start releasing news articles within 5 minutes. It could be within an hour. And so you want to be aware of everything as soon as it happens. And so that's why you want to be on this on a daily basis. Now, if you're not sure what any of these are, feel free to click on it. A new tab will appear, and it will provide you a small paragraph of what it is and sometimes how it can affect the stock market. So in this case, the EIA, Short-Term Energy Outlook, which is the Short-Term Energy Outlook, or the STEO, provides the United States Energy Information Administration, or the EIA, near-term perspective on the energy markets. Each month, the STEO provides forecasts to the end of the next calendar year for consumption, supply, trade, and prices across the major field types. In addition, the CTEO provides in-depth market analysis for crude oil, petroleum products, and natural gas markets. Although its emphasis is on the United States energy markets, the STEO also includes forecasts for certain international liquid fuel markets. So this is definitely a very important economic report, because it's an economic report that you don't normally see on here. Because there are weekly economic reports, there's monthly economic reports, there's quarterly economic reports, and there's yearly economic reports. So the ones that are more rare have a bigger impact on the stock market. So especially if it's a yearly economic report, which we'll see usually during the first quarter, so January, February, and March is when we'll see a lot of the yearly economic reports. And so that's where we see a lot of bearish characteristics, because a lot of times the yearly economic reports, they'll say things that investors don't want to hear or don't like, or it spooks them, and so they begin to sell, and so the market usually kind of plunges a little bit. So, but this will have a big impact. There's no really previous or forecast or anything, but we'll have to kind of wait to see how this will affect the stock market. Now, this looks like it's going to be released about 2.5 hours after the stock market opens. So Tuesday morning during pre-market, it may be a little, may have a low volume activity, low buying and selling activity. So we'll have to wait to see how this affects the market that day, because after that point in time, that's when we're going to see a lot of activity, a lot of volume. So going into Wednesday, December 8th, we have the job openings report for the month of October. So again, knowing the time on these, this economic report is scheduled to be released 30 minutes after the stock market opens on Wednesday. So this is going to be another economic report that'll have a big impact on the stock market on Wednesday. And so this is where a survey done by the United States Bureau of Labor Statistics to help measure job vacancies, if it collects data from employers about businesses, employment, job openings, recruitment, hires, and separations, where the JOLTS defines the job openings as part or all positions that are open, not filled, on the last business day of the month. A job is open only if it meets all three of the following conditions. And so this is where you can really kind of learn more about these. And once you learn more about these, you look at them, you already know what they are and what they mean. Or like in this case, if you have a reading that is stronger than forecast, is generally supportive, a bullish for the US dollar or the stock market, where a weaker than forecast reading is generally a negative or bearish for the US dollar or the stock market. Now, most economic reports the numbers need to be up. They need to be positive, but some reports need to be down. The lower the number, the better, like unemployment. or crude oil inventory levels. If those are down, if they're lower, that means people are driving, they're being active, they're shopping, they're spending money. Unemployment, if the numbers are down, people are working, they're paying taxes, they're spending, they're shopping, they're doing good things for the economy. And so this is where it's really important to learn what these are and how it can affect the stock market. So 30 minutes after the job openings report for October, then we have our crude oil inventory levels. Now, this is a weekly report where the last week was reported down 0.9 per a million barrels, which is good. The lower, the better. But this was Thanksgiving weekend. As we mentioned last meeting, this was really to be expected because during Thanksgiving week, a lot of people are driving because they're traveling. Now they're back. And so I would expect that it's going to bounce probably back up. And so that could provide some bearish characteristics. Job openings. Now, we did have some information on that last week. It was very disappointing because it did not meet their quota, their goal. So I would also anticipate that, and it's weird because they don't even have a forecast in here yet. They're like, I don't know, what should we pick? So we have to look at this maybe later today, see if the government maybe put a forecast in here, because right now they're like, I don't know, or somebody forgot. But if not, if they're not there today, then they'll definitely be there tomorrow morning, and we need to see what their forecast is because I don't think this is going to look good. Because the job openings, I don't think the government has really created enough jobs, especially not 10 million. Because they were thinking that last week they were thinking there was going to get like a 500,000 jobs opening for a particular segment. There was only like 100,000. So that is a warning. I believe that this is going to be a lot lower. So that's not good. And that may be anticipated as well. So that could create a lot of bearish activity during pre-market before the stock market opens. So definitely a little concern for Wednesday. Thursday, we have our unemployment report for Thursday. This report is scheduled to be released 1 hour before the stock market opens. So that will definitely affect the pre-market. Unlike these other ones, pre-market is going to be very mellow. It's not going to be as active unless we get a lot of bad news. Then the market's going to plunge. But there's just not enough positive news to create bullish activity, I think, going into next week. But with the Thursday, though, with the unemployment report scheduled to be released 1 hour before the stock market opens, the previous report came back up a little bit, which I thought it was, because the week before that was 199,000. It was the lowest it's ever been since the shutdown last year. But just like I said last meeting, when it does that, when it drops significantly, it always bounces up a little bit, and it did. But it wasn't as much as what it was previously, because the previous one, several weeks ago, was like 240,000. So it was still good news. It still had a little bounce, but I would anticipate that it's going to bounce off of that, and it's going to come down. So it looks like to me that the bar is set low in a figure of speech, where I believe that it's going to be lower than this, and it's going to be lower than that. So Thursday, I think, looks good. I think we're going to see a lot of bullish characteristics because the bar is set pretty low. There's a lot of people there's a lot of jobs out there. There's still a lot of businesses that have staff shortages, that are still hiring a lot of people. We're getting closer and closer to the holidays. More and more people are working, trying to generate more revenue. This should definitely be lower. I cannot imagine it being any higher than any of these. So as long as it meets or beats that, we're good. If it can beat that, we're even better. We're on full bull mode here for Thursday. Then going into Friday, December 10th, we have the core CPI for month over month for the month of November. This is also scheduled to be released 1 hour before the stock market opens. So where the previous report was about 0.6%, looks like it could be down a little bit at 5%. hopefully maybe the bar is set a little low on that. As long as it meets or beats that, we're fine. If it can meet or beat the previous report, we're even better. And so, that's kind of to be determined. But again, if you're not sure what these are, you can always click on it, pull up the information. It will provide you a small paragraph of what the CPI is. The core consumer price index measures the changes in the price of the goods and the services, excluding food and energy. And so that's inflation. Inflation is a change in prices of your goods and services, which a lot of it has came up over the time, which just means more, revenue for Uncle Sam and businesses and whatnot. So that's just good for the economy. And so I would think that this number is definitely should be higher, because I've definitely seen a lot of prices up higher on many things. So I think the bar is set a little low on that. So I think we'll see some bullish characteristics. So it looks like that maybe possibly because Monday, who knows? Both Monday and Tuesday is really uncertain. We got a lot of negative news that's coming in the pipeline. And then Wednesday, Wednesday doesn't look that great either. But Thursday, Friday looks like it's the best days of the week. And so, usually what we'll see, we'll usually see one day's positive, one day's negative, one day, then the next day's positive, next day's negative. But it looks like that the beginning of the week could be negative, and then we'll slowly transition to a positive as we head towards the end of the week. Let's take a look at the week after that, just to see what. And so it looks like there's a lot more things that are scheduled to happen on Tuesday, December 14th, and Wednesday, December 15th, and Thursday, 16th. We got 3 days of a lot of activity going on. So there's going to be a lot of volatility that day. A lot of, just like what we were talking about a few minutes ago, a lot of up and downs, a little consistency. So nothing on Monday. We got the PPI on Tuesday for the month-over-month of November. Looks like it could be about the same. And then we got a lot of other economic reports, like our retail sales will be scheduled 1 hour before the stock market opens on Wednesday, December 15th. And then we have the government that's going to talk about their economic projections. They're going to want to talk about getting ready to start increasing interest rates as soon as January and next month. But they'll also talk about inflations but also they may also talk about our debt deficit, and which is really right around the corner. Once they start talking about debt and that we need to prevent government shutdowns and stuff, that could also create a lot of volatility. And so, but this, Wednesday next week is going to be a crazy week. But we got to focus. We're in this week. But it's always good to know what is going to happen by planning ahead, by looking at this stuff, regularly every day. Because when you look at it every day, something could change. They could add something. They could add, a new economic report, or maybe reschedule it, or maybe they'll add a forecast, which we need to see right here. There should be a forecast under the job openings and crude oil inventory, but there isn't right now. So we'll have to update this regularly. So the next big thing that has a big impact on the stock market is earning reports. So, and I always post every Saturday, I post in our Facebook group under the featured area or announcements, the top 10 economic reports that are scheduled to happen this week, along with the schedule for the most, some of the high market cap companies. So we have Monday, Tuesday, Wednesday, Thursday, Friday. We have before opening, after close, and then the main ones are pretty much on the top. But the top 10 I'll put here in the description. So then we have the first one, number one for the week. Most anticipated is ChargePoint. We have GameStop, Lululemon, Chewy, Costco, AutoZone. We have the restoration, home or housewares, or whatever, science applications, Lovesac, and Broadcom. So shortly after I post this, and I post this consistently every week, I post the top 10s analysis in here, starting with this one. Now, Broadcom, and I always post, I try to post an image that has a little bit of a clue along with the description and the name of the company, because if you hear Broadcom, you might not know exactly what it is. Now, a picture can say 1,000 words. It's a microchip manufacturer. Now, they do a lot of stuff with networking, but also a lot of microchips. Well, there's a shortage on microchips. We just talked about this last week, and we talked about this with many other things. There's a shortage on microchips. And that's why vehicles aren't. The automotive industry isn't able to build as many vehicles, because every vehicle requires at least 1,000 microchips, if not more. If you have a loaded, like an F-150 Lariat pickup truck with every single bell and whistle, that truck needs 2,000 microchips to have it work. And a lot of these newer vehicles are what I call a connected vehicle. They're connected to the internet. And to have a connected vehicle, you have to have a network chip or several networking chips to be able to communicate. And that's what Broadcom is. It's a network microchip. There's a shortage on microchips. And so this is, when you have a short supply with a high demand, you have a very, very interesting situation. So Broadcom is scheduled to release their earnings Thursday after close on December 9th. This company earnings release has an 86% chance expecting an earnings beat. Out of every single company that's scheduled to release their earnings this week, this company has the highest percentage chance that they're going to beat their earnings and the stock is going to go up. We said this last week on Marvel Technologies. They had a very high percentage. I can't remember what it was, like 84% or something. They also dominated with the highest percentage chance that they were going to beat their earnings. And they did, and they surged 20%. It was more than I thought that they were going to do. I thought they would maybe go up 5%, maybe 10%, but they did 20%. They did a phenomenal job. Now, Broadcom is more of a well-known company. They've been out, I think, a lot longer, but they're a higher quality microchip. But out of this week, this is the highest one. So the news is going to be really paying attention to this one on that day. Now, remember what a lot, if you don't know what the pros say, they say buy on rumor, sell on news. And the reason for that is because if something is anticipated to happen, and most likely it's going to happen, you got to own the stock, because if it hits the news, it's too late. So if you're like, for example, Marvel, it surged up 20%. If you just now got the news and you're like, oh, they surged up 20%, they should keep going, right? And they buy into it, and then they just bought it at a very high price. When they could have bought it well before that, and have taken the advantage of this situation. And so that's that for Broadcom. Next one is the Lovesac. Very interesting name. If you're not sure what Lovesac is, again, the picture says 1,000 words. Look at that. That looks so comfortable. But they also do, not just little bean bags, but they do, sectionals and things like that. But Lovesac is scheduled to release their earnings Wednesday morning before the stock market opens. The company earnings release has a 53% expecting an earnings beat. Now, keep in mind that these earnings are based off of the third quarter revenue, and so third quarter is what? August, September, August, September, October. It'd be July, August, September, because then you have your October, November, December is your fourth quarter. So I mean, we're like at the end of the fourth quarter. So sometimes sometimes investors can forget that what time that these earnings are based off of. So we got the July, August, September. So what normally happens during that time? People are on vacation. They're not really looking for a bean bag. They're on vacation. They're going out stuff. So 53% expecting an earnings beat for Lovesac. That's a coin toss. And so we just don't know exactly. It's very high risk. So you definitely want to avoid that. because if you convert these into an odds, that's 1 out of 2 odds that the stock is either gonna beat their odds and surge, or maybe they'll plunge, versus like the Broadcom at 86%. That's almost a near 90%. That's like 9 out of 10 odds this stock is going to beat their earnings and revenue, and the stock is going to go up. That is a very, very low risk situation compared to a 50-50 odds. Very high risk. Now, next one is the Science Application International Corporation. I didn't really find a good picture, but this is a company that does try to develop things for I think space programs, but also the military and other things. I just don't think they're getting a lot of business, but they are expected to release their earnings tomorrow morning, so Monday morning before the stock market opens. The company's earning release has a 42% expecting an earnings beat. That is very, very low, probably the lowest percentage out of any other earnings that's scheduled to be released this week. So that's very, very poor. So here is the Restoration Hardware store is scheduled to release their earnings Wednesday after the stock market closes. The company's earning release has an 83% expecting an earnings beat, which is very, very high. So they must have I've never been to one of these stores, but they do have a lot of great reviews and great products and furniture. But it definitely makes me wonder why 83%, especially during the summertime of July, August, and September. Maybe a lot of people wanted to buy some really nice furniture before the holidays. Before Thanksgiving. I mean, it does happen, but it's very interesting how it is unusually high. Now, when we look at this information regularly, the average percentage expecting an earnings beat is around 65 to maybe 70%. So any more than that is considered above average and unusual. If it's any less than that, it's definitely considered way below average. So 83% is definitely considered unusual, but also way above average by a lot. Now, AutoZone is scheduled to release their earnings report Tuesday morning before the stock market opens. The company's earning release has a 65% expecting an earnings beat, which is again average. Costco is scheduled to release their earnings report Thursday after the stock market closes. The company's earning release has a 73% expecting an earnings beat, just slightly above average. Then Chewy.com, they are scheduled to release their earnings report Thursday after the stock market closes. The company's earning release has a 59% expecting an earnings beat. Now, when the pandemic started, I mean, Chewy was a phenomenal company. A lot of people started to buy their pet food online as a lot of stores were closed, and they started to do that. But more people are, starting to shop more in stores and stuff. So I think their sales have really dropped down quite a bit. The 59% expecting an earnings beat, that's definitely considered below average. So that's not good. Then we have our Lululemon, little clothing here for athletic people that like to work out, do yoga and whatnot. This is very, very popular brand. Usually you got a little pocket here, you put your cell phone in. And this is a great sales for year round, whether you're working at or working out inside or outside. People usually buy these year round. And so they're scheduled to release their earnings report Thursday after the stock market closes. The company's release earnings has an 83% expecting an earnings beat, which is really, really, really good and considered above average. And so GameStop, a lot of people are going to be focused on GameStop because of the activity that it's created throughout the year. GameStop is scheduled to release their earnings report Wednesday, December 8th, after the stock market closes. The company's earning release has a 54% expecting an earnings beat. So, sometimes people forget that before GameStop became very, very active earlier in the year. GameStop was on the verge of going bankrupt. Microsoft wanted to help them out, do a little, help them out with some software stuff, and you scratch my back, I'll scratch yours, type of thing, just to kind of keep them afloat. But they were like a $3 to $5 stock, all day long. People don't go to GameStop to buy games anymore because people like to download them. It's more convenient. Plus, it doesn't wear and tear the discs and stuff. You can't just steal them. It stays on your account. So if you change consoles, you can always re-download it. It's just a lot more convenient just by downloading it. So GameStop over the years has kind of turned into more or less a gift shop where you can kind of buy little items and things like that, or accessories and whatnot. But over the years, they've really drastically have lowered their revenue tremendously. They were on the verge of going bankrupt. But one day earlier this year, a Reddit group decided to teach certain hedge fund companies a lesson, because what hedge fund companies usually do is they bet against stocks like GameStop or maybe Sears or Toys R Us or whatever, because maybe they're on the verge of going bankrupt. They'll buy a bunch of puts on them, betting against the stock, but then they'll throw in, they'll buddies with some news companies saying, hey, throw in some bad news about the company, make their stock go, let the stock go down, convince people to sell, and make the situation even worse. Because what happens is when they do that, then the hedge fund companies win. They're gaining billions and billions of dollars, and that's not fair, because we're losing these companies that we absolutely love, that we grew up to as kids. And one day this Reddit group, Wall Street Bets, decided enough is enough. We're going to retaliate against these hedge fund companies. We're going to save these companies that we absolutely love, and we're going to profit from it. And so the Reddit Wall Street Bets group decided to, let's pump these stocks up, starting with GameStop and AMC. And I watched AMC and GameStop go from $3 to $5 to, in GameStop, it went from $50 to $100 up to $400. I mean, it was nuts. And it created so much volume and volatility that it crashed the Robinhood servers and many other things. I mean, it was just a big mess. But it became stock market wars. It was us against the hedge fund companies, and the government kind of stepped in. It was a big mess. But I mean, GameStop, the price has been kind of fluctuating around that $200 range for quite a while, because what the Wall Street Bets is trying to do is we're trying to keep these stocks afloat. It's not a matter of trying to profit from them. It's trying to save them and trying to retaliate against these hedge fund companies, because when that happened, these hedge fund companies lost billions and billions of dollars. They were on the verge of going bankrupt. They had to file for like bankrupt protection and get loans and stuff. I mean, it was crazy. It made world news. It was that bad. And so with GameStop being here, I mean, a lot of people will always kind of keep their eyes on them because of what's been going on this year. But 54% expecting an earnings beat, that's not good. This is not a long-term stock. This has just been a very volatile stock that's just meant for trading short term. So don't think anything of it. It's just not a long term. And eventually, I think this little trend will probably begin to die off next year. So very interesting story, but yeah, it's just good to know and to be aware of. Now, the next one, last but not least, is the charge point. The charge point is the most anticipated earning release this week, because I've been doing this for very active, like I said, for the last 4 years. When I even created this group 4 years ago, and I've never posted this charge point on here. So for it being the first time on here, there's something special about it. Now, obviously, you're looking at the picture, it's an electric vehicle charging station. We're seeing more and more of these pop up everywhere, at Walmarts, at grocery stores, at downtowns, or whatever. It's becoming more and more common. More and more Americans want electric vehicles. More than 30 or 40% now are ready for an electric vehicle and will be buying an electric vehicle very, very soon. So they're just expanding the infrastructure. So a lot of places are buying these and installing these everywhere. So ChargePoint is scheduled to release their earnings report on Tuesday after the stock market closes on December 7th. Pearl Harbor Day. The company's earning release has a 77% expecting an earnings beat, which is slightly above average. That is really, really good. And we convert that into odds. That's a 3 out of 4 odds that the stock's going to beat their earnings, and the stock could potentially go up at that point. So, you know, a lot of people are going to be looking at this very, very closely as we get closer to the closing on Tuesday. So it's very, very good to be aware of that, but also as we really have dived into a lot of this stuff that's scheduled to happen this week, there's an article that investing.com posts on their website. It's the top 5 things to watch in the markets in the week ahead. And so as we click on it, it will take us to the investing.com website. And because after we've done our due diligence, we need to look at this to see, did we miss anything? And we never want to miss anything, because, you know, we don't want something to happen and be like, I didn't know that was going to happen, and it fluctuated or did something to the market. And so it's just, we need to be aware of it. So number one, the highest number one thing to watch for this week is this silly Omicron uncertainty stuff, but it just does create a lot of volatility in the market. So we need to be aware of this type of manipulation, because there's a lot of things that can manipulate the stock market and that we got to be aware of. So the number of countries reporting as Omicron cases is continuing to rise, not only in countries but also states. Yesterday, my local news company, I'm in Washington State over here in the Seattle region, and they just reported that there are now cases in this state. So that could possibly easily affect our stock market tomorrow going into Monday. So, but scientists still highlight this here. So, but scientists still do know whether, or do not know whether it is more infectious than other variants. What is the severity of the disease, or what level of protection is provided by existing COVID vaccines? It will likely take several more weeks to get these answers. Now, obviously this is BS, because, and again, you sometimes we got to think, you can't bullshit a bullshitter. You know, we have to be able to identify whether a politician is lying or not, but our government is highly intelligent. Our scientists are highly intelligent. They know exactly whether this is good or bad, or if it's more infectious or not. They absolutely know it without a doubt. Now, by them putting this in here that they do not know, is because it creates uncertainty. If the investors see uncertainty, that they'll pull out, they'll sell, and that's obviously that's the objective of this. As you are now aware of, this seasons we're entering the bearish season, so we need to be able to pour fuel on the fire, or at least that's how the government's thinking. The prices of stocks are too high. They need to be able to come down before they can kind of keep going back up. So we need good buying opportunities. What better way to do that? By creating uncertainty, especially if it's uncertainty that's more or less as harmless as much as possible, you know, rather than anything more significant. But this is the uncertainty part of it. So Omicron variant appears to be spreading faster than the Delta, which accounts for 99% of the current transmissions. The emergence of the new strain has pummeled financial markets and undermined the global economic recovery, just as countries were beginning to emerge from the lockdowns triggered by the Delta. The International Monetary Fund warned Friday that it is likely to lower its global economic growth estimates due to the new variant. Now, this again will affect our stock market, but if China keeps retaliating, you know, in the cryptocurrency world or with other things, that's going to really affect the stock market more than this whole Omicron uncertainty thing and whatnot. So we really got to be aware of what China's doing, as well as the variant. Number 2, inflation data. This was, again, as we were talking about the economic reports, this is going to have a very big impact on the entire stock market system. So the highlight of the economic calendar will be Friday's November consumer price inflation. Remember when we were saying how Friday or Thursday, Friday looks like it could be more of a positive area, where the beginning of the week looked like it'd be more bearish. So again, this is kind of confirming that information now that we're kind of diving into it, where the US CPI accelerated 6.2% in October, the fastest annual increase in over 30 years amid a global supply chain crunch, and is forecast to rise 6.7% in November. Another strong reading could underline expectations for faster tapering by the Federal Reserve. Last week, the Fed Chairman Jerome Powell said that the central bank will likely discuss a faster wind down of its stimulus program in its meeting later this month, adding to speculation that the interest rate hikes would also be brought forward. Okay, so there's a couple issues here that are basically letting us know that, about bearish characteristics. So the wind down of the stimulus program, so meaning less people are going to not receive the stimulus money. So right now, parents, people that have kids are receiving, $200, $300 a child. So there's still people that are getting stimulus money, but I think all that is going to be done this month. I think this is the last month that people are going to receive certain stimulus programs. So going into January, I think there's going to be a cutoff. Plus, they're talking about hiking interest rates, which is not good, for the economy, because as the interest rates go up, banks are going to make money. So we're going to see bank stocks; those are going to go up. But pretty much everything else is going to start going down because people aren't going to be buying. They're not going to be shopping as much anymore because, especially with the interest rates going up, people are trying to buy a house before the end of the year because they don't, or refinance their house because they're trying to lock in this lowest interest rate, because if interest rates start going up, people are going to, buy as much and so same thing with vehicles, so people are trying to buy right now. So once we get into next quarter, we're going to see the sales are going to drop. So, but right now, December is going to be pretty, retail sales and everything are going to be pretty amazing. They're going to be pretty crazy. So now Powell also said the word transitory was no longer the right word to describe surging inflation. Friday's employment report, showing the smallest growth in job creation so far in 2021, did little to alter expectations for faster tapering. While the economy added just 210,000 jobs in November, the unemployment rate dropped to 4.2%, its lowest since February 2020. So with the jobs report, there was forecast to be 550,000. It was significantly less. So that's why I think this week, when they start talking about the jobs report, I think it's going to be very low as well. And so that's not good. So number 3 is volatility set to continue. Stocks sold off last week, hit by a double whammy of uncertainty over the Omicron variant and prospect of faster tapering by the Feds. The turbulence looks set to continue, with investors bumping shares of growth technology companies in favor of value stocks, which include companies like banks, financials, and energy firms, expecting them to perform better as the Fed normalizes monetary policies. Value stocks rallied earlier in the year as the United States economy reopened, but faltered later as investors rotated back to the tech shares. The Fed brings the punch bowl, and they are the ones that remove the punch bowl. This Michael, whatever strategist, whatever. Markets are quickly repricing their view of the future, blah, blah, blah. Number 4, the crypto sell-off. Bitcoin, the largest cryptocurrency by market value, fell as much as 20% on Saturday. Yesterday, amid a broad-based sell-off in digital currencies in the wake of a volatility week on the equities markets. Then Ethereum, the second largest cryptocurrency, dropped by more than 10% before pulling back, while other widely traded digital currencies, including Dogecoin and Shiba, also tumbled. by a lot. Concerns over a regulatory crackdown may be clouding the outlook for crypto investors. On Wednesday, executives from major cryptocurrency firms, including Coinbase, are due to testify before the United States House Financial Services Committee amid calls for regulations of notoriously volatile market sector. Prospects for faster rate hikes could also be weighing on the outlook for cryptos, as higher rates make holding prospective assets less attractive when the Fed last hiked rates in 2017 and 2018. Bitcoin prices fell considerably. Well, this characteristic with cryptocurrencies is normal anyways. It's perfectly normal, and but Bitcoin will eventually reach $120,000. It's eventually it'll reach $250,000. It's inevitable. It'll reach $500,000. It's just it's not a matter of if, but when. Because of the Bitcoin halving is how it makes it inevitable. Now, number 5 is UK GDP. Now, this report does have a somewhat effect on our U.S. stock market, but not as much as all the other ones that we went through. So we don't really need to mess with the Bank of England because, again, this isn't going to create. They just put 5 on here because they probably just ran out of something to put on here, so they just threw this in here just to fill in the 5th place. So we don't really need to mess with this one as much as some of these other ones that are really going to create a lot of volatility in the stock market. Now, we need to look at some activity in some stocks. Now, I really do a lot in options. Options, whether you are in options or not, it can still provide a tremendous amount of valuable and intelligent information. Now, with a website that I use, it's called barchart.com. If we click on the options part of the menu, there are several little options areas here. For now, we want to click on most active options. So when we click on that, it'll sort out by the highest volume in options. Now, this sorts out the entire system in one page. So out of all of the options, everything's sorted out by the most active one. So Apple dominated last Friday's activity of almost 1.2 million in options volume. Now, out of this amount of volume, 56% bought calls, where almost 44% bought puts. So again, a put is betting against the stock, betting that the stock is going to go down either that day or the next day, typically. A call is betting the stock is going to go up. So normally when we see this, 56% of this call options is betting the stock is going to go up either that day or even the next day. And so when we look at this information on a regular basis every day, we can see what stocks are normally on here and what stocks are not normally on here. And so when we see something that's not normally on here, we can consider that unusual activity. Like DocuSign is not normally on here, but they are. But they're only on here because there's a lot of activity on here. They plunged 42%. It's obviously being manipulated like crazy because they they did pretty good with their earnings. So they're definitely being manipulated tremendously, and we want to take advantage of that. So but so far for Friday, out of this amount of volume, almost 56% are buying calls, and then 44% are buying puts. So this could be also a strategy as well, especially when we start to see 50-50 type stuff. Now, a straddle is where you buy both a call and a put. A lot of people don't know you can do that. A lot of people think that doesn't make sense. Why would I bet the stock goes up and bet it goes down? Well, I always tell everybody, you can only lose what you put into one side, but your gains on the other side are potentially unlimited. So what if you lose 80% on one side, but you gain 300% on the other side? How much did you really lose overall? Nothing. because the gains that you got on the other side wash out the loss on the other side, and it puts you ahead. You could be up ahead 150% overall in a matter of one day. So now you can have your cake and you can have it and you can eat it too. You can have, both situations no matter what. And so volatility is one of the key ingredients to straddling. If straddling is not as effective if the market doesn't move. If it's flat, then we're not going to really gain anything or really lose anything. But the longer we're holding an option, each side does suffer some amount of time decay or time depreciation. So you don't want to hold too long, because otherwise you're suffering time decay. But if we have a volatile market like what we're having now, we can profit tremendously. Even it doesn't matter what the market does tomorrow. If the market surges tomorrow, we'll profit from it. If the market plunges down tomorrow, we'll profit from it. It doesn't matter. We can, and so we can try to maximize. So we can buy our calls and puts at the same time, or we can buy them and sell them at different times to maximize our gains and to minimize our losses. So, but it just depends on you and your strategy and what's going on. But we can also try to identify things, like I said, that's not normally on here. Lucid, maybe not always on here, but there's quite a bit of activity on there. But we can always scroll down too. Now, the percentages here, normally, just like the earnings report, 65%, maybe 67% is normally average. Any higher than that is above average. Any less than that is below average. So we have Ford Motor Company. They were down quite a bit, but they have 70% of buying calls on one of the reddest days. 70%. Obviously, Ford must. A lot of investors are very optimistic that this stock is going to go up Monday. And so, and that's where we want to kind of look at this one. There's Uber. Uber was down almost 6%, but they have almost 80% call buying ratio. It's like they're very, with this, there's a saying that people say, follow the money. That's it. This is it. This is where you can see where people are putting their money. Are they betting that the stock's going to go up, or are they betting their money that the stock's going to go down? Rather than looking at comments or words or people's optimism, their emotions, follow the money. And so sometimes we may be able to find even something more significant. Like whatever this company is here, 94% call ratio. That is way above average and considered very, very unusual activity. Going something that high when you're in the 90% range, whether it's a call or put. There's another one, this Danny Trace. I have no idea what that is. Almost a 99% call ratio. What in the world is going on here? And they're a 59% ratio. So what we can do now, so if Danny Trace is DT is a ticker name, we can go up to the NASDAQ website. What was it, DT? Or you can Google DT NASDAQ most active options, and it'll pop up this page. Or you can change the ticker code in the URL address for the NASDAQ. That way we can see the most active individual calls and puts for that stock option. So that way we're kind of really narrowing it down for this particular stock option. What's going on here? Why do people believe that this stock is going to keep going up? And how far do they believe it's going to go up? So we have the most active calls here. We have the most active puts here. Obviously, there's very little puts. All the activity is in these calls. Now, the price of this stock is $59. We have a $65 call strike price and a $60 call strike price. So, and again, if you're not into options, that's fine. This is still valuable information, because if people are betting that this stock is going to reach $65 and it's currently at $59 right now, that is a 10% gain if you're buying it as a share. Now, if we click on it, $65 strike price, we'll have an expiration date. So that way it'll kind of give us an idea of when these investors believe it's going to reach $65. That way you can kind of anticipate, when am I going to get my 10%? So they believe that this stock's going to reach $65 before February 18th. So you can easily buy shares of the stock and gain 10% within the next couple months, So it could be, a safe thing, because when you're looking at the amount of volume on this compared to the open interest, because the open interest, it's just showing a lot of previous interest on this. But this one here, the $60 call, had no interest. And now all of a sudden it's got a tremendous amount of interest, well, due to volume. Now volume is today's buying and selling activity. This obviously is showing 99.99% buying activity, because only 47 have been previously holding. And then come Monday, this volume that resets every day will now accumulate inside the open interest. So it'll merge itself. So this 36 will merge in with this 40,000 and so on. And then the volume resets back to zero. And so there's a lot of unusual activity going on with this stock. And so that's where we can really keep scrolling down, find anything. But again, we have the rules. Have a rule of some kind of volume. Again, my rule is option volume 100,000. So I'm right here on up. I'm not looking at anything down below. I'm looking at things that are very active, very anticipated. Because we need volatility. We need volatility, so that way we can make a lot of money. And so again, this is under the barchart.com website, options, then most active options. Now, if we click on options volume leaders, this will provide us, out of the entire option system, the most highly active individual calls and puts, and it sorts it out by volume. So that way we can see which ones have been the most active by volume. And so now DTE, this is very important to know. DTE is the days until the option expires. So when we're looking at this either on a Friday, Saturday, or Sunday, we're going to see a lot of zeros here, because it just expired. It just expired Friday. So looking at it now, this one is obviously invalid. It no longer applies because it's expired. It's going to be out of the system as we go into tomorrow. So we got to look at ones that have numbers in them, or be aware of how many days that it expires if we're looking at this on a daily basis, and looking at the expiration date, knowing when it's going to expire. Now, so that means that out of everything, the most active call and put is this Apple call. Now, Apple is just under $162 a call, and we have a call strike price of $165. It is the most active one. We have about almost just under 75,000 in options volume, with 40,000 in open interest. So, but because the volume is higher than the open interest, this provides unusual activity and a lot of buying activity. So there's a lot of investors that believe, as we go into Monday, that we could have a bounce where the Monday could be in the green. And so there's a lot of investors that are very optimistic that Apple is going to be in the green, or at least maybe reach $165 by the end of Friday. But not that you want to hold it for that long, because the time decay could be a killer. But we'll just have to see what happens, because there's a lot of uncertainty going into tomorrow. But again, a lot of investors are optimistic just by looking at this. Then we have American Airlines with a put strike price. American Airlines is number 2 most active individual call and put. American Airlines is currently at $16.62 with a put strike price at $17. So obviously it's already in the money, which there's nothing wrong with that. In fact, I recommend if you're buying a call or put, buy it at the money or in the money. Try to avoid buying out of the money, because if you're out of the money, if your strike price is past your the share price, the system doesn't always believe that it's going to reach that, and so you suffer more time depreciation and time decay as if you were at the money or in the money, meaning the share price. But this put strike price expires in 14 days approximately, or in December 17th, which is also a day, it's called Triple Witching Day, which we'll talk here in just a little bit. Triple Witching Day, though, is a very, very bearish day. Most likely that day is probably going to be the biggest bearish day of December. It might even be the bearish day of the quarter. You thought Friday was bad, wait until Friday, December 17th. But this is probably a good choice, good strategy going with this, especially as more and more countries are implementing either travel restrictions as well as our country. This is not good for American Airlines, but again, bad news is good news. We have open interest of 27,000 and a massive amount of buying activity at 68,000 in volume is pure buying activity, betting against American Airlines, betting that they're going to keep going down. Now we may see more American Airlines here, but this is a good strike price, even though it's past it. More Apple, we have an Apple put, so there could be some straddling going on here as well, which there's nothing wrong with that. And we can kind of notice that straddling activity because the volume is near the same. We have 66,000 in puts and 74,000 in calls. So there could be some day traders in there a little bit, but the swing traders look like overall that they're straddling. They're uncertain. They're not sure exactly what Monday's going to be like. But for every 1% Apple moves is like a 50% gain or loss in the options world. So if Apple's plunges 3%, you're going to gain 150% on the put, and you're going to lose probably 80% on your call. So putting your head and gaining overall 50%, that is a great strategy, and there's nothing wrong with doing that on a daily basis. You can buy 5 minutes before close, and you can sell 5 minutes after open, and do that every day just like clockwork. You don't have to keep hunting for other stuff, and that's why Apple is one of the most popular, most commonly traded stock option to date. And so, but it's good to kind of look at other unusual activity, maybe something with a very, very low open interest, like Alibaba. This one here is expired, so that doesn't apply. But you can kind of continue looking at other ones. Those ones don't apply, those are expired. But Friday definitely provided a very low amount of activity. So there's not really a lot of, I think, activity here that I'm seeing other than straddling Apple. Let's see here. And then we saw the DT right here, as we were talking about. That is one of the most active, activity here on this list as well with the DT. So, but expires 77 days. February 18th, just like what we talked about on the NASDAQ website. Now, we could also click on the unusual options activity in the options menu just to see if there's any other unusual activity that we may have missed. So the options volume here and the open interest, it tries to kind of find the biggest difference between the two, providing a massive amount of unusual buying activity. Now, for volume, I usually like to see something that's like, 20,000 or 30,000 with a very small amount of open interest. So I'm not seeing that. I'm seeing 7,000, 10,000, 13,000. So I'm not liking what I'm seeing. There's an 18,000, 24,000. So that now we're kind of getting somewhere with AMC with $28 call strike price. Oh, that's expired, so that don't matter anyways. That's expired. So, but I like to see things more close to the top of the screen. I'm not seeing anything. So then down below, we need to look at straddling and strangle activity. Now, both of these are the same, where you buy both a call and a put, but the difference between a straddle and a strangle is that the straddle is you're buying the same strike price, $10 call, $10 put. The strangle, you're buying a different call strike price than a put strike price. Because maybe, let's say your whatever you're looking at is $50 or $55, or your share is $55, but you're looking at a $60 call and a $50 put. That would be your strangle. But either way, it's the same concept. But I still recommend trying to stay at the money or in the money. So what we're looking for when we're looking at straddles and the strangles in this area is what we're trying to do is we're trying to find multiple of the same stock option. That's how we're able to identify unusual activity of straddling. So looking for the same thing, multiple ones, we have Pfizer, which is PFE is what I'm seeing here. I see 1, 2, 3, 4. So I see 4 so far that dominate. I wish it was more close to the top of this list, but it's on the list on the first page that we're seeing here. So we can consider Pfizer on our watch list to straddle, because Pfizer can be very volatile, especially with this whole Omicron thing. There's going to be a lot of news. There's going to be a lot of competition between Moderna, Pfizer, and whatnot. Taking a pill versus the jab and this and that. I mean, Pfizer could shoot up 5-10% and it could plunge 5-10%, which is the volatility that we need for straddling. It's the ingredient. It's perfect. All the stars align. So Pfizer definitely is on our list for straddling. Let's go back, and then so we got short, and then we got long. So we got to click on all 4 to identify things that have a multiple amount. Now we have AMC. AMC is on this list. Now we got Pfizer, AMC. AMC, very volatile just as well, especially as we approach Triple Witching Day. The Triple Witching Day, as we talked about the AMC and GameStop event, the hedge fund companies, their expiration to try to get stocks to plunge is on every witching day. Triple Witching Day, which only happens 4 times a year on the 3rd Friday at the end of every quarter, which is coming up on December Friday the 17th. So now, between now and then, we need to try to pump up GameStop, AMC to prevent that from happening, and try to retaliate against the hedge fund companies and to continue saving the companies that we love. But there's nothing wrong with straddling. If AMC plunges 10%, you're going to gain a lot on your puts. But AMC, I'm not in favor of straddling AMC, because AMC does suffer a lot of time depreciation on both calls and puts. So I would avoid doing that. But if you do get into that, buy 5 minutes before close, sell 5 minutes after opening the next day, because now you're avoiding time, and that means you're avoiding the depreciation. Then we'll go to short strangle. Let's take a look and see if there's any unusual activity here. Looking for any multiple things. So I see AUPH. I have no idea what that is, but I see there's 6 of them. We got 1, 2, 3, 4, 5, 6. So this is an $18.67 share, and it looks like we have a $30 call, $15 put. So it looks like there's some expected some volatility coming to this one pretty soon, because we have a very short-term expiration. So something's going to happen, and we need to do some due diligence on AUPH. We're going to add that to our watch list and see what's going on there. And then last but not least, the long strangle. Also looking for multiple things of the same stock. Let's see what it says. Anything? Come on. Oh, right here. So first thing on the list is BKKT. Again, I have no idea what that is, but we have a $13 share price. But there's a lot of activity on this one. But there's 2 there. Any others down below? No, but there's only 2. I wish there was more, but having it on the top of this list, definitely, definitely we need to keep our attention on there. So that's another one we got to put on our watch list. Going down, we got more AMCs. So we got AMC on 2 pages, not just 1. So more volatility ahead on AMC. As we can see, a lot of investors are betting on both, betting the stock's going to go up and it's going to go down. Anybody have any questions about options or anything? Everything makes sense? Anybody want to go over any options or any stocks?
Yeah, I had a question, Carlos. You said like straddling, sometimes you buy at the same strike price, but other times you buy at a different put and a different call price. Why is that, and when would that be applicable?
That is a great question. I'm so glad that you asked that. Let's go to, let me close some things here real quick. I got too many things that are open. I'm going to open up the Webull, and we're going to look at some things. Now that we're more familiar with moving averages, that's when we can buy calls and puts at different times. But you have to be careful when you do that. You have to be a little bit more experienced is what I would recommend. when you
and
do
then,
that.
And then let me interrupt you. And then a
Yeah.
second part to that question, when would you know to get out of those positions?
And so that would be, I'll show you here. Let's go.
I guess another EMA indicator crossover of some sort.
Yeah, definitely. So let's go for, so we're on Apple. So this was Friday so this is Friday on Apple. So let's say we're looking at trying to figure out what to do to swing trade. And we decide to, or no, hold on. Let's go. Let's say opening on Friday. We wait. We wait for an indication of some kind. Wait for the volatility to end. The first 30 minutes or an hour, and then it provides us a signal of downtrending. So we can buy a put there, and then it goes down. And then we can sell the put as it begins to provide us kind of a buying signal in a way, which is the opposite for puts. We can sell the put, we can buy a call. And then you can kind of go back and forth doing it that way. Or you can go with the 5-minute chart just to kind of smooth it out a little better. There we go. So with the 5-minute chart, everything's a lot smoother now. So that way you can buy the put there, or whatever. Or what you could do towards the end of the day, why my screen is kind of messed up here. That's just weird.
And then also another part to that question, Carlos, is are you a fan of bull or bear credit spreads where you buy? I don't know how it works exactly. I'm gonna look into it further, but it's like you buy a put and then you sell a put, or you buy a call and you buy a call at a different strike price, and that way you can compound profits, but then the only cost is the credit. Does that make sense?
So yeah, so when you're buying an option, you're buying a contract. You are buying a contract to temporarily have 100 shares at a fraction of a cost. So rather than buying, let's say, because Apple right now is $161 a share, almost 162. If you were to buy 100 shares of that would be like $16,000. And so, but if you buy a contract simulating a 100 shares, but a contract would be like $250. For every $1 Apple moves from $162 to $163, that's $100 gain because it moved $1 times 100. So when you're buying a contract, it's like you're only buying part of it. A fraction of the cost. Kind of like if you're in a real estate, you buy a house, you're looking to buy a $200,000 house. All you're going to do is flip it really quick because the market's doing really well. You buy the house, but you're using the bank's money. You put only 10% down. That's $20,000. You turn around and sell that house for $240,000. In a matter of a couple weeks because it's a hot market. Right. And your investment was only $20,000. Use the rest of the bank's money. You're $20,000. Now you have $40,000 in profit. That's a 200% gain. So options is kind of the same thing where you're using kind of like somebody else's money in a way, and only part of yours. And that way you can gain a substantial amount with just a very little investment.
Sure.
But as we approach every day towards the power hour, usually the last 15 minutes, it could be 5 minutes or 20 minutes, but normally it's 15 minutes before close, the market may shift. It may go up or may go down. So if it goes up like this, this is providing a buying signal going upwards as the price kind of comes up. We want to buy a call because if we buy a put, too early, we're going to lose a lot on our put too early. And because right now, this is about 10 minutes before close, it picked a direction. We want to buy a call. And then as it goes up, our call gains. And then we want to buy our put maybe 1 or 2 minutes before close, because we're right here. We're in the last like 2 minutes before close. We can then buy a put. And then that way we're not at risk of losing on our put going into the next day. That way we're maximizing our gains and minimizing our losses. But you can still buy at the same time if you want.
But you would buy a put at the end of the day because you think the next day is we're going to start lower than where we were the previous day?
Well, yeah. I mean, you're not always sure. You don't always know. But what we could do is if we buy a call here, and by the time it gets to here, we could have gained 10%. And if we buy a put here, and if it goes down a little bit, we may lost maybe 1% or something on the put. So now as we go into tomorrow, we're up ahead 10% already.
Right. Okay.
Rather than 0% or down a little bit.
And then we have the put in our arsenal, and then we can do
Correct.
it as we will after open.
Correct. And then as we go into the next day, Wednesday, let's say next day is the same exact algorithm from Friday. So as we go into Monday, let's say this is Monday, tomorrow, we can, and it's down, we can watch to see what happened. Now our put is going to be up a lot. Our call is going to be down a lot. So, but as long as it goes down, we can now say, okay, we need to sell our call and prevent any further loss. We'll hold on to our put and continue to gain that until it provides a signal to sell. Now, I would have sold my put right here as it was kind of hesitating. I would have secured my profits. I would have sold my
your call further up. Okay.
Yeah. If it goes the other direction, you hold on to your call, sell your put, even if the stock market's down. And you gained a lot on your put, sell that thing, because now the price is going up. You're losing your gains on your put, and you're minimizing the loss on your calls. But some situations you may sell your put and secure your gains, and now you're minimizing your losses on your call. But sometimes the call or the price may recover and go positive. So now your call went from a negative to a positive. Now you just sold your put for positive, you sold your call for positive, and it was a win-win. And that's where you can really maximize your gains and minimize your losses on that. But again, you can still buy your calls and sell your calls at the same time. You just might not gain as much. But overall, it should be a big gain overall, no matter what.
Right, but that's also based on market volatility, and especially volatility with that underlying stock, right? Yeah,
absolutely. And again, you can change your graphs. Just depends on your settings and everything between your 1 minute, 5 minute chart. Just depends on what you need to see. If you need to smooth certain things out, and certain stocks, it may become more clear. Like the 5 minute chart here seems to be more clear than the 1 minute. Or the 1 minute may provide other, too many signals or false signals, where this one kind of provided a little better one. So with the 5 minute, you could have held your put all day long because the moving average lines never crossed over each other. You could have sold your put at the end of the day and secured even more gains.
Right.
And so, but straddling is a very, very highly effective tool. Let me show you something here too. Let's go back to the NASDAQ website.
Well, another thing too, Carlos, with a lot of those, and I appreciate, the earnings and, 83% above and all this, but a lot of those are big cost options. I'm starting with an account that's much smaller, and, I'm looking, I think one of them was lower in cost. Right.
Yeah, and we can always find stuff like AMD, Apple. Apple can be pretty, cost effective, but we definitely want to keep a certain price limit on our options, because if the contract is like $5, for every dollar it moves, that's a 20% swing. And so you definitely want to make sure that the price of the stock option is at least, $50 or $100, per contract. Now, looking at Tesla, I just threw in Tesla in here because Tesla was, I think, down like 4% last Friday. You can see that the calls were basically vaporized. They're down over 99%. But the puts, look at the puts, up 400%, 300% there. We have some other ones that are a little smaller. Because when it comes to straddling, we want to use and optimize the shortest expiration. Because the shorter the expiration that it is, the more volatile that the option's going to be. So if you have an expiration that's further out, the less volatile that it's going to be. So when it comes to straddling, we want volatility. We need to be as volatile as much as possible because we need it to come up as much as 400% or as low as 100%. So if you gain 400% on one side and lost almost 100% on the other, you're still at a win. You just gained like a huge amount of money just from that situation, whether what was going to happen or not. Volatility is our key ingredient of our success here. Any other questions or any stocks anybody would like to go over? Everything makes sense?
Well, how do you feel about DocuSign? Can we chart it real quick?
Sure.
I wonder if it's going to go lower.
So typically,
and why is it going lower? I know the earnings report showed, positive earnings, correct?
Correct. The reason why when a stock does this after really good earnings and plunges almost 50% is because of manipulation. Somebody ever watched that movie Wolf of Wall Street? There was a part, but there was a guy in there who was developing shoes, like Nike shoes or whatever, and he had a great relationship with the Leonardo DiCaprio, and then he did something, he started to sell, and then Leonardo DiCaprio was like, just tell everybody to sell. We need their stock to go down to a penny stock. It's the same type of situation. Somebody told somebody to sell a shitload and just to manipulate the stock, but it's not really, most likely it's nothing really personal. It's more or less probably an opportunity. It's a great buying opportunity because normally when something like this happens, it usually takes a couple days before it turns back up or finds the bottom. So going into Monday, it could go a little lower. I'm not exactly sure, but we can always see looking ahead.
But also with such a drastic move, how do you find the bottom?
We have to focus on the moving averages. The moving averages help provide information. So we can use Peloton as an example. A couple weeks ago, Peloton went through the same situation. However, their release earnings based off of the third quarter. Peloton makes exercising equipment. The third quarter again is July, August, September. What do people do at that time? That they're either working outside or they're on vacation, not indoors working on their treadmill. But going into winter time, a lot of people are indoors because it's cold outside. They're going to be working on their treadmill. They got the New Year's resolution or whatever that they got to do. They're going to lose weight or whatever.
That's a good point.
So most likely, this is going to be exactly the Peloton's, or not Peloton, the DocuSigns little algorithm. So the stock goes down and it kind of, take a couple days and then it bounces back up, and it may continue to come back, shoot back up after that, or it'll continue to go down, but we have to wait for that buying signal. It hasn't provided us the buying signal yet because the price line needs to cut through all three moving average lines, and to be completely safe, the moving average lines need to cross over each other, just like some of these other ones. That provides us the last and final buy signal. And not only are we aware of this, but the guys on Wall Street are, all the other professional investors and traders are. They're getting the same buy signal that you are. They're going to buy into it. They're going to start pumping it up. So we all need to be on the same page. We all need to work together, even though we might not communicate together at the same time. but the graphs are. If they're saying now is the time to buy, everybody's going to start buying, and this thing's going to start going up.
And Carlos, when they make that decision, is it based off of, a daily time chart, 4 hour, 15,
Typically that'll be the daily chart, which is what we're looking at now. Every little notch here is 1 day. And so once it becomes a sell signal, that means a buy signal, that usually and starts to trend upwards. That typically means almost every day the stock's going to open up in the green. And so now you'll start seeing more calls activity and just more activity on it, maybe on the news or maybe on Yahoo Finance and stuff. So, but I would anticipate this is going to probably happen soon. I think DraftKings was another one, wasn't it? What's DraftKings?
Somebody wanted to look at DraftKings, yeah.
Well, I can't remember the ticker there. There it is, DraftKings. Okay. Yeah, DraftKings kind of did the same thing. Yeah, they didn't have really good earnings, but this is another thing. This is another great stock that does very, very well in the fourth quarter. So what these politicians and investors are doing is they're manipulating it, because these stocks that do very, very well during the fourth quarter, when they release their earnings during the first quarter, these things are going to surge, and they're going to surge before their earnings release comes out. So these are great buying opportunities, but we have to wait until we find the bottom, because we don't want to buy when it hasn't provided us a buy signal yet. We have to wait. We have to be patient. We have to stick with our system. We got to think strategically, analytically, and focus on the process. Otherwise, our emotions will affect our buying and selling decisions, and that's going to be a mess. Because then if you buy too early, then you have to keep buying more to either lower your average cost, or you're gonna have to sell at a loss, and then you're like, why did I do that? I shouldn't have done that. It's like, and so, but yeah, we just have to listen to these, and that's when we can tell what the bottom is by looking at this and waiting for it to change its course of direction. But also the patterns, because maybe it'll provide us a pattern of some kind here pretty soon, letting us know what it's going to do. So especially when the stocks go down like that, there could be good, bullish patterns just from it going up. It could be the descendant triangle. I mean, it could be the falling wedge. Let me pull up that really quick. There's not very many bullish patterns that go down, but like the falling wedge right here, you can see where the stock falls down. It kind of zigzags down for quite a bit, but as it gets closer to the end of that little funnel there, that's when it's going to react, and then the moving average will provide you your buying signal, and it's all these little pieces of the puzzle just really play very well together. Descending triangle, so you got to be watch out for that one. Make sure you get all the angles perfectly, because with that angle, it could be either or. By the time it gets to the end of there, which kind of look like the DraftKings. So let's go back to DraftKings really quick. That descending triangle, what was that? Like right here, this looks like the descending triangle where the stock price goes down. It's kind of zigzagging there really quick. And then it was either going to pick or down, and it goes down. So then now you can buy the put, bet against it, let it go down until it provides you the other signal. Any other questions or any other stocks anybody would like to go over?
Hi, Mr. Carlos. How about your thoughts on Palantir?
Oh, Palantir Technologies?
Yes, sir.
Let's take a look at a couple things here. So we're on the daily chart for the Palantir Technologies. They've been ultimately, they've been ranging all pretty much year long. It's kind of up and down. Obviously, right now they're downtrending like most things are. They did provide a sell signal back in the beginning of November, but we're definitely down. And just waiting for a buy signal, but let's take a look at some other things with some options. Let's go over here. Let's see what or do investors. So with Palantir's Technology's most active calls and puts, we have a lot of calls that were bought. But then again, when we see the open interest, we have open interest of 30,000 and the volume's at 23,000. So that could mean that these 30,000 people could have sold that call to get out of it because this is going down. Now we look down below here, we can see the puts, especially this particular one that had a very low amount of open interest, but a very high amount of volume that exceeds over the open interest. But because the value is so low, most likely this is expired now. But the volume seems to be about roughly the same overall between your calls and puts. So I would say it's kind of to be determined as we go into this week. Investors are really uncertain of a lot of things, but I think we're going to learn a lot about what's going to happen, I think, here for the rest of the month as we go into next week with the variant and the crypto and China and whatnot. So it's going to be a very volatile week, but it doesn't look very, it looks very uncertain. Any stocks anybody would like to go over, or anybody have any questions? Everything makes sense?
Carlos, can we go with electric cars?
Which one?
Rivian.
What's the ticker?
RIVN.
Oh, Rivian?
Yeah.
What was their ticker name? Is it RIVI? Oh, it's not popping up.
Just type RIV. It'll come up.
RIV.
Or just RI. It'll pop up.
It's RIVN.
Yeah, first
Okay.
one. First one.
Okay. And since they're a new IPO, I mean, there's, so when you talk to a lot, the main professional long-term investors, like if you were to ask them, when would you invest in an IPO? They'll typically say, I will usually invest in an IPO usually after the third earning release, because they just have more financial information. There's more of an algorithm. And so then I'm like, okay, I guess that kind of makes sense. Because right now there's just not a lot. And if we base it off of the moving averages, it provided us a sell signal. It's downtrending. We don't know for how long or for how far, but eventually we got to wait for the bottom and wait for the signal to buy, because then it's going to change its trending direction. Just not sure how long it's going to be, but again, we are entering the bearish season, so it could be quite a while. Do you have any particular concerns or questions about Rivian or anything here?
No, it's because I invested in the IPO. That's why I need to get your feedback about what's going on. Yeah, especially if it went from 78 to 170 something. Then
yeah, it is a crazy amount. I mean, it jumped up like a lot. Now, I'm going to flip over to the web browser. I'm going to show you something really, really cool that I had discovered quite a while ago, but it's basically the top 25 automakers by market capital. Now, Google posts this information and it's live every day. So when the stock market's open, these numbers are flickering. But this is the top 25 automakers in the entire world. And so you can look to see who's the wealthiest one, who has the highest market cap. And so Tesla, obviously with over $1 trillion market capital, leads the world in the automotive industry and the electric vehicle segment by a lot. Now, Toyota used to be number one for like decades. And so Tesla all of a sudden, like over like a couple years ago, boom, dominated the entire list just in a very short period of time. Volkswagen's always been like number two. But a lot of these Chinese ones have really trickled up on the list for quite a while. NIO was in the top 10 for quite a while, and a lot of these other ones, but now we finally have some really good American electric vehicle companies. Rivian has really dominated this list. They were kind of on the bottom not too long ago when Rivian was $170 a share. They were number 3. They were above. It was Tesla, Volkswagen, Rivian. I was like, how in the world can Rivian just step in like that and dominate the list, number 3? Obviously, it's manipulation, because Rivian, they're not worth that. They're not worth what they are. They're not worth $104. They're probably worth more what the IPO price was, around the $70 range. So it just determines, what the market feels that it's worth, but we have to wait, find that bottom. But Rivian should be kind of in the middle area. They shouldn't be on the top. They're on the top. They're in the 6th place, but we'll see them come down a little bit. Lucid's also slowly coming up there. Lucid recently, what was it, a month or 2 ago, was awarded an American EV company finally had the highest range of 500 mile range electric vehicle, and so that's huge. So that really brought their value up and brought their market cap up. So I think eventually we're going to see Tesla, Rivian, and Lucid are going to be the top 3 most valuable market cap American automotive companies in the world.
So do you think that's maybe a good long-term investment, Carlos?
Oh, absolutely. Rivian, Lucid, absolutely. They'll come up. Tesla, as more people, as they get more competition, more competitors, eventually Tesla value is going to come down. They'll probably still maintain the top, but Rivian and Lucid, all these guys, they should.
And then another thing I'm thinking is SpaceX is associated with Elon and Tesla, so SpaceX potentially declaring bankruptcy could lead to Tesla going down, correct?
That definitely that could. I don't think that could really ever happen, but who knows? Anything can happen.
You think that's also manipulation?
Yeah, definitely. I mean, Elon Musk is a master at manipulation.
Master manipulator,
yeah.
Hey, Carlos.
Yes.
Can you go to Moderna?
Say that one more time.
Moderna.
Yeah, let's take a look at Moderna. Take a look at a couple things here. Let's take a look at the options. Sure. I'm trying to remember what the ticker is. What's the ticker for Moderna?
DRN?
It's MRN.
No, I got it wrong.
It's just MRN.
Oh, MRN?
Yes.
No, it is MDRN.
No, there's another one. There's a 4.
MDRN?
MDRN.
Okay. Wait, MDRN now.
Oh, that's not it. Oh, jeez. Apparently we should all not invest anything.
Yeah, I gotta look on my phone here. Okay, mRNA.
mRNA.
There we go. Okay, so Moderna. So some of these are going to be expired. Usually, to identify, you can either click on them, or if you see that basically that they're worthless, they're expired. So with these 3 active calls, they're expired. Then we have this one. This is a $2 per share. So that's a $200 contract. So that one being active, we have a open interest of 718, but a lot of volume at 5,600. So that's showing a pure amount of buying activity.
Somebody needs to mute their mic. Come on, guys.
Let me see who it is. There we go. Okay, I muted everybody, but you'll have to, when you have a question or something, just go ahead and unmute. Wasn't sure who had the feedback there, but so yeah, unusual activity on that one. So 305 is the most active call for Moderna. Coming down over here on the puts, we have to see. Let's see if this 305 is still current or not. We're at 0.25. It is expired, so that does not apply. here. So the next one would probably be the 310. Let me double check on that one. Make sure that one's active. December 3rd, no, that's expired. That does not apply. What else? That one, that can't be. So we got 315 put. It's expired, doesn't apply. Weird. That's got to be expired. 280. December 17th. Okay, so really out of all the puts, this is the only put that's active. So with that, we have an open interest of 1,400 and the volume of 1,200. And then over here, let's double check, make sure this $300 call strike price is active. No, that's expired. Okay, so that doesn't apply. Let's go 400. 400? Wow. 400 expires February 18th. So that's the top most active call strike price for Moderna. So Moderna right now is 306. It was up Friday on a very, very bearish day. So investors, okay, so out of this, we have the open interest is less than 1,500 and now the volume of 4,500. So that's showing a massive amount of buying activity. It's up last Friday 34% in one day. $400 strike price. That is just huge. But from where it's at now, $300 to $400, that's over a 30% difference. And so normally you don't want to do that because of the time depreciation. But if you're buying it as a share, that might not be bad. You know, go from $300 to $400. That's again 30% gain. But options, you know, it's a little uncertain. But that's what we're seeing so far. Investors are betting that this is going to reach $350 and $400 by the middle of February. And not so much puts, because all these puts are expired. The only one that is active is this $280 put, which could be just like an insurance play for straddling, just in case if it doesn't do what these investors believe that's going to do, reach $350 and $400. So let's take a look at the charts on Moderna and see what it looks like.
Carlos, it could be because people think Moderna is going to have good news with Omicron and, you know, new vaccine technology.
Exactly, and that's how we can try to find things that may be flying underneath the radar, things that are about to happen but haven't happened yet. We can see a lot of, you know, unusual activity by finding these stock options, looking at the dates and the strike prices, because most likely it probably really is going to reach $400 by the middle of February, because with the winter time has a very high contagious it's a flu season. Basically the winter time is the flu season, and we're really right around the corner. So the government and these drug companies, they're going to manipulate this as much as they can, and they're going to try to get these stocks to surge as much as they can. And I'm sure, you know, Biden is one of the most biggest shareholders of all of these, and that's why he wants to go door to door to vaccinate everybody or jab everybody, because, you know, it's just going to make him money. And so, but as a shareholder as well, and in investing, you know, it's kind of the same thing. That's why a lot of people don't really like investing into Moderna and Pfizer and stuff, because we kind of look at these as bad guys. Because all they are playing games with our lives, but at the same time, you know, we got to keep that emotion out. We got to think analytically, strategically. These guys are going to make us a lot of money, and so that's where we're seeing a lot of straddling activity on Pfizer, and now we're seeing that Moderna. So looking at the daily chart on Moderna, we obviously see that it plunged down. Well, it just recently provided a buy signal. Not just on the MACD, but on the moving average. The MACD provided us a buy signal prematurely, a little bit right here at this line on November 19th. You can see that the MACD has a first green bar here. Again, that is the gap distance between the two moving average lines. So it's letting us know, hey, it's getting ready to provide a buy signal. all eyes on this. Get ready. And you could have bought maybe a little early Moderna at $253 a share, or even at the next one over here, or even when the moving average lines crossed over each other over here when Moderna was around $279, because it's letting us know it's getting ready to trend upwards. It's going upward where all stocks are going down. This one's going up. And it's still pretty early, you know, we're at $200 or $300, and that's why now we're starting to see, now that it provided a buy signal, we're starting to see this activity in the options world of these investors with their strike prices, because they believe Moderna is going to reach $350. They believe it's going to reach $400, which really isn't that far away from where it was. You know, this is kind of like our resistance level now. This is our support level now. It's right kind of in the middle. Remember the rules? Buying between the support and the resistance level. That's kind of what this is right here, as well as the moving averages. So everything's in line with Moderna. So I'm glad that you brought Moderna up, because this is a great example of what's to come and what to look at and what to see with a buying signal, because we're not able to see a lot of buying signals because the way the market is, we're seeing a lot of sell signals. So it's good to see what a recent fresh buying signal looks like. Eventually this will keep going up, and then the MACD will create a much bigger green little mountain bars here for probably, you know, the next month or several months. Hopefully that makes sense. Does anybody else have any other questions, or are we good?
How do you know, like on the 1 minute or 5 minute chart, if you're seeing, you know, lower lows or higher highs?
And so usually early in the morning, you always default to the 1 minute at first. And so
you have to zoom out to get a good look at it, I guess.
Yeah. I don't know why my chart looks like that. Hold on here. I think I have to update my software.
Are you on the desktop version?
Yeah, I'm on the desktop version.
Okay.
Which very similar to, you know, the tablet as well as the phone. But so the 1 minute, you know, the stock market opens, you know, and you want to keep it on this for at least, you know, 15 minutes or 30 minutes before you switch over to the 5 minute. But then you can double it. You can do two graphs. You know, you can do 1 minute on the one, 5 minute on the other. That way you have 5 minute there, 1 minute there, and that way you can see both of them at the same exact time. That way you're not just seeing one or the other. You can have them side by side or on top of each other. But then, yeah, but always default to the 1 minute at opening, because that's where it's going to really provide you some very critical signals, whether it's going to go down or up for the majority of the day, or at least the first half of the day. In this case, Moderna was down for the first 15 minutes or so, and it kept going down. And then as it goes up, then you can kind of switch over to here, because with the 1 minute chart, maybe there's too many signals now. We got a buy signal, we got a sell signal. We got a buy signal, almost a sell signal. Where if you look at this one, you don't have those amount of signals, because it's a lot smoother now. It's just a sell signal or to buy a put, all the way down to the bottom. Now you sell your put or buy a call. Where with the 1 minute chart, there was just too many. It was just too many activity. So later on throughout the day, that's when you want to switch more towards the 5 minute chart over the 1 minute chart. But opening, definitely the 1 minute chart. Any other questions anybody have or want to go over anything? If not, I do have some resources I can share with you, which I'll share a bunch of stuff with you in the chat rooms here in a little bit. Everything that we talked about, the videos, the moving average, all the rules, the little cheat sheet with the patterns. I'll put that in the chat room here for you guys for your resources.
Your fifth cup of coffee?
Yeah, good cup of coffee.
Last day of vacation until your first goal.
Okay.
Are you fine with coming
there is a
down
couple
on the
things.
26th, or do you...
I'm gonna mute you, George. there's a couple other things I wanted to go over before we go. Let me pull something up here because it's pretty fresh. I want to talk about a correction because a correction may have been triggered, but I want to show you what a correction looks like. So what is a stock market correction? So recent high, that's kind of where we've been. The triggered events, that's most likely what had taken place last Friday as we went through a variety of different bad news, especially with the crypto and China and threatening and all this other stuff. Most likely, it's a domino effect. So most likely it's been triggered. The correction, usually we'll see a decline of 10% or more, and it could last typically for a couple weeks or for a couple months. But this is normal. This is absolutely normal, so do not panic. But if you are holding shares, you might want to think about selling them because you can always buy you can always buy them back at a lower cost because they are going to get low, unless it's Moderna or something. But that's just what the correction is. So just know this is a normal yearly cycle that happens regularly every winter, and then about every 10 years or so, more or less, there's a massive correction. Like the housing crash in 08, and then the shutdown last year and whatnot. Now there's another one I want to show you too, another image. I found this on Facebook early last year. Somebody wrote it, they must have handwritten it, made a copy of it, pasted it, but it says fear strikes. Basically, they were trying to give the message is stop watching the news, stop believing their BS, just live your life, wash your hands, be clean and whatnot. But, just don't let the news affect you and ruin your life. But when I saw this, I was like, oh, I'll be damned. This is all manipulating the stock market. And that's when it clicked. So in 2000, remember Y2K? Oh, the power was going to go out, or your bank accounts were going to go to zero, or maybe they could go to $1 million. They created uncertainty. None of that was actually going to happen, but they created so much doubt and uncertainty that they created the stock market to crash throughout that time. Created a lot of uncertainty. During 1999, during the fall season, November and December. So in the year 2001, we had the anthrax scare, where they kept saying, because we were, in that, Middle East war and whatnot, that the Al Qaeda or the Taliban were mailing people letters with white powder in it with anthrax. Well, all of a sudden, Wall Street got a package or an envelope with powder, and they had to shut it down. They just created all this uncertainty because they were thinking that they were mostly going to target, government buildings and things like that could mess up our economy. And then the next year was West Nile virus. And the next year after that was the SARS. Next year was the bird flu. And then 2006 was the E. coli. Then 2008 was the financial collapse. So that's the 10-year thing, the 10-year cycle. But then these other ones are the yearly cycles. In 2009 was the swine flu. 2010 was the Mayan calendar the world was going to end. 2013, the North Korea's going to start World War III because they're always launching missiles in the air. Well, nothing's changed since now and then. 2014, the Ebola. So I guess they're running out of ideas. So 2015, the ISIS is going to kill us again. 2016, it was the Zika virus. And then 2020 was the coronavirus. But notice there's a big gap between the 2 years because that's when Donald Trump was president. Donald Trump being Republican. You can see this is more or less the ideas that Democrats like to use to create volatility in the stock market, or the Republican will usually create something else, something more logical, not as extreme. But Donald Trump being a Republican president, he did tariffs with China. So it was more or less like there's a volatility in Chinese stocks and certain stocks that are made in China, like the iPhone or whatever they're manufactured over there. They're having issues with that. And so, but just know that every year it's always something, and every 10 years it's always something major. And so just know that this is never going to end. This has been going on for years and years, and that it's always going to be something And as you are becoming a veteran trader and investor, that you know this stuff, and that it's just manipulation. It's not really real. They may use something real and make it seem worse with uncertainty and all kinds of stuff, but all they're doing is manipulating it, making the system more volatile, creating a much better opportunities, but it's usually for them, for them. So we just have to know all this stuff, just like a board game, like playing Monopoly. The more rules that we know, we can understand, and we can take advantage of the situation, so that way we can profit and prosper from this, because the stock market really does provide an unlimited amount of income and revenue. So hopefully this all makes sense. If you guys ever have any questions, feel free to message me in our chat room on Facebook Messenger. We'll do this again next Sunday. The more you learn, the more you earn. You guys, please be safe. We're going to make a lot of money this week. Just try to focus on straddling throughout this next month or even the first quarter. Straddling is going to help save our gains. It's going to make us more gains, and it's our safest play that we have going into the winter. So I'll continue to post things in our Facebook group. Let me go to our web browser here. Everything that I post in our Facebook group always gets saved in our featured announcements area. It's like my bookmarks. It's one of the reasons why it made it our group so successful, that we have almost 250,000 members. It's because we utilize the information that I save in here with valuable information. So everything gets saved in here, including the options activity throughout the previous week. And I'm starting to do the morning stuff, pre-market. So let's start focusing on that. It'll kind of give us a better idea of what stocks to look for in the morning before the stock market opens when it comes to stock options. So look at this. So the DocuSign was number one. That became the huge news. The Marvel Technologies, Apple, and then the previous day before that, I had another one in here, I think. Maybe not. Okay, but I'm going to start.
Carlos,
yeah.
When you post that DocuSign information, I mean, that was we're a little late to the party at that point. Although it was like breaking news about such a drastic movement, we're too late to move at that point, right?
Well, so we talked about this last meeting, and they had I think it was 56% or so. It wasn't that great of the odds. Here's DocuSign there. They had 76% expecting earnings beat. So it wasn't that bad, but it was also a pandemic stock. So meaning where it really surged because it was a necessity. It was something that was really needed
during that time frame.
Because a lot of people were home. People wanted to buy cars, they wanted delivered, but they wanted to sign without going to the dealership and stuff. But now people are more wanting to go outside. They're tired of being cooped up in the house, and so people aren't using it DocuSign as much as what it was. So a lot of investors believe now it's time for DocuSign to stabilize from its high levels, even though they've beat their earnings and revenue and stuff. But they need to come down now before they can come back up. And unfortunately, that's when we need, if they have a high percentage of beating their earnings and the price is already high, the price may be already factored in, knowing that they're going to beat their earnings regardless. And so that's where we have to be careful. If the stock price is low and it has a high percentage of beating their earnings, most likely the stock is going to surge, not the other way around. So that's where we got to be really careful. But when we were talking about it being a pandemic stock, it definitely put a lot of caution in this because it needed to come down before it can come up. So even though it had a high percentage, but even though the best time to trade a earning release stock is when or after it's released, not before. Especially if you're into options. If you straddle options with a earning release, you're going to most likely be affected by what's called implied volatility crush, or also known as IV crush. Okay. what that does is the news affects the value of both the call and the put, and it usually lowers the value of both. Even though, let's say whatever the stock is, and it beat their earnings and they surge up 10%, your put, you probably lost 90% on your put. You could still lose on your call, but maybe you gained 10% on your call when really you thought you would have gained like 300%. So that's where I highly recommend do not trade options through an earning release. Do it after, not before. So, but this after, so DocuSign earning release was after close on the the previous day. And so, but they had released, or maybe it was, I can't remember, but they had plunged down to like 30% before the stock market opened. So I posted this. My time zone is 5. Well, I'm in the Seattle region, so I'm in the Pacific time. So stock market, my time opens at 6:30 in the morning. I posted this 1 hour and 15 minutes before the stock market opens, alerting us, our group, that DocuSign is going to be the one that we need to trade, as well as Marvel and as well as Apple. And so with Marvel being down that much, most likely they're going to keep going down. But we can still day trade them. We can trade off the little bounces that they do, but we have to be aware of the patterns. And in the morning, the DocuSign provided the bullish, or not the bullish, the bouncing dead cat pattern. Let me see if I can pull that up on the.
So Carlos, potentially once DocuSign settles and provides a buy signal, it's a good time to potentially look into buying a call, correct?
Correct. Yeah. So looking at the 5-minute chart on DocuSign, we can see that the stock price falls and it bounces once right there. That's the dead bouncing cat. And then it bounces back down. It starts to kind of hesitate around this area here, but then it just continues to fall the rest of the day. This is the bouncing dead cat pattern right here. But we can still buy a call on the bounce and take advantage of it, especially with the MACD right here. But it's just such a small little tiny bounce, or you can do it there or here. If you do on the third line, you can buy the call, and then sell around here. You'll make a little bit, but not a whole lot. But you definitely don't want to be optimistic. Think, this is going to go up the rest of the day. You buy the call, and it told you to sell, and you're still holding that call. Now you're back down here. Now you're at a wash, and then you keep holding.
That's what I did with Apple this past week. I bought one. I went to the grocery store. It was up $80. I should have sold it. But like you said earlier in the video, I didn't have a plan. So now I know better. Lesson learned. I'm ready to look for signals and
so a good way. So let's say that, because a lot of investors don't have an account with $25,000 or more. That way they're eligible for unlimited day trades. So let's say you are kind of day trading without any day trades, but you're going to have to hold. So if you buy a call there, a good way to secure your gains is to counter it with a put. So if, let's say you buy here and you're up here and you have, you're up, 10, 20%, buy a put. Because now what happens if it goes down, your put is going to gain, you're going to lose on your call, but you're still secured that 10% or 20% or whatever that it is.
All right.
But if it keeps going down, that you may have lost now 20% on your call, but on your put, you may now be up 50%.
But couldn't you have already sold your call at that point? You're like, hey,
only if you have a day trade.
Okay.
But if you're doing this without any day trades, you just you exhausted your day trades, but now you're SOL and you're panicking, you're holding and you're not sure what the next day is going to be like, counter it with something, with a put or a call or whatever that you're doing, just to make sure you're locking in those gains no matter what, just by countering it.
Right. Yeah, well, I'm happy I locked in my losses at, it was like $120, so not a huge loss, but now I'm going to be more strategic for sure.
And that was on Apple.
Yeah, it was on Apple. I don't even remember when it was. I was just excited. I went to the grocery store. It was up. I bought I think it was a 170 12/3 expiration. I bought it on 12/1. And then like, I think 12/1 it did something nice. And then it went down from there. And I was just like you said, on the amateur side of that board, amateur versus professional, the amateur side, I was hoping it would go back up. And of course it didn't. And the next day I lost more.
Yeah. Being optimistic because you're emotional about the situation and everything. And you were using
not knowing any better.
Yeah. You're hoping that it was going to do something. And that's where we got to remove the emotions out. We got to remove the hope. We can identify these emotions, but you have to practice it. You have to be like, oh wait, that's my hope thinking, that's my hope talking, or and or your emotions. You got to think, logically. Don't be optimistic. Be realistic and strategic. This is a battlefield. This is war. This is mental warfare, and so we cannot let it win. We have to go in there with a strategic plan by covering our bases, no matter what, like flanking the enemy or something. That's straddling. We're covering both sides, no matter what.
Yeah, that's a good analogy.
All right, guys, I'm sorry it took so long. Usually this takes about 2 hours. We're about 3 hours and 20 minutes into it, so it's gonna be my lunchtime. So this is a recorded session, so eventually I will upload this to Facebook. Half of our class is out because it took so long. But if we ever need a recap, you need to look over anything, you'll be able to have access to that. We can rewind and kind of look at certain parts of this video in case you missed something or whatnot, was distracted or got here late. We can always watch it from the beginning. It'll take me probably a couple hours to kind of render the video and upload it and whatnot, but it'll be on there later today. But in the meantime, while that's taking effect, I will post all of the materials that we use and then some. I'm going to show you something that you guys are also going to get since you guys are here and all the other guys left. I'm going to give you guys a bunch of books. I know a lot of people learn differently. A lot of people learn with hands-on. A lot of people learn from watching videos. A lot of people learn from listening, or a lot of people learn from reading. If you're one of those that learn from reading, you are going to absolutely love our amazing stock market library. This costs a fortune. All the stuff that we're talking about is highly valuable information, and you guys are going to get this access to these ebooks. So like Day Trading for Dummies, you just click on it, boom, you have access to the PDF file. You can download it to your phone, your computer, your tablet. It's kind of a big folder or file there. But whether you want to learn options, penny stocks, predicting any market, whatever, but keep in mind that an author and a YouTuber are going to tell you what you want to hear, because it's a marketing strategy. That way you'll buy their book, or as a YouTuber, you'll watch their video and get all these clicks and views and whatnot. I'm not like that. I don't care about views and clicks and all that stuff. I'm about the real deal stuff, all the most important stuff. Because a lot of times, look at the amount of pages that it's on here. It's a lot. You may be able to pick certain stuff up here and there. 317 pages. That's a lot when we just covered all of the major, most important stuff in a matter of a couple hours. And so, but this is still really great information that I'll give you guys in the chat rooms in our group, and that way you'll have access to this. These are the primary books here on the top. These are subcategories that you can also click on. So if you wanted to learn more candle trading, you can click on that, and then you have all these candle trading books right here. This is our stock market Bible that we live by. Stop orders collection, learning more about trailing stop losses, as well as stop losses. You can get a lot of information on here. So it's all about learning. The more we learn, the more we earn, the more that we can help each other out as a phenomenal trading team of what I call stock market ninjas. So it only just makes us better. So I'll upload this in our chat rooms for you guys' reference as well. Thank you so much. You guys have been amazing. We'll do this again next Sunday, every Sunday, same time, same place. Thank you guys. We'll talk to you in a little bit.